Welcome, everybody, to February. Can't believe we're in over a month already into these very, very interesting markets. Certainly a little bit different than last year, and even different than 2021 January, where things just completely ramped up as the year began. In those 2 years, a little bit of a different vibe here right now. We're having a little bit of pressure in the WTI contract, but overall supply demand is looking good, as was presented in the macro outlook there last week. Kind of a seasonal low point for demand overall, and the Chinese reopening as well. It just started, seeing really good results on the domestic jet fuel consumption. The international jet fuel is picking up, and then the within kind of intra-China gasoline and diesel are looking pretty good, along with some of the train trips and whatnot coming back too. So as we saw in some of the other countries that opened up post Omicron, or a highly transmissive sort of disease or pandemic, I should say, there were quite a few people who were avoiding some of the subway systems and instead choosing to buy vehicles. That data kind of tailed off as the year went on, but there's still a one-time sort of effect to that. And we'll see how this all shakes out. I don't think anybody really knows exactly what's going to happen at what time frame, but we get the data almost daily on some of the flights. We get some weekly data and then some monthly data as well, and just kind of paint a picture as to how things are going. But overall, looking pretty good. It had to happen, I guess, unless you were betting on the world's biggest economy in terms of energy consumption collapsing out of nowhere. So, there's a lot of factors that happen. Been having some really interesting discussions, and kind of the some of the narratives that are going on, both on Twitter Spaces, in my personal sort of life, and then also just kind of what I see and what I read around different forums and everything else going on. So I'll kind of today's session will begin with about a few slides on macro. Just a little bit on the macro narratives and why some of them are not correct. I've shared some of this information earlier, but I do think there is a significant issue right now happening with people picking up on noise and then amplifying that noise to a level where it seems to be kind of a big factor. But when you look into the actual data and impact as to what's happening, it's not really something that's new. Or it's not really something that means a lot. It's just something that became an easy explanation to throw numbers out. So look forward to sharing that. I'm going to share a couple quick slides on sort of the cycle and its non-linearity and what sort of happens there. And then we'll get into the 2022 review. I'm going to be sharing every stock, option, warrants, whatever that I held, that I currently hold, and then every transaction that was closed in 2022, and a few other extra ones, just to kind of go through a few things. It's not meant to be a copy these trades thing. It's not meant to be going to show how well things have gone. There's things that made money. There's things that lost money, and more so it's a session just for me to kind of maybe share some of my thoughts, and then share some maybe things to look for that we don't really watch out for. So when times get really euphoric, when times get really let me just add in here. So when times get really kind of desolate, just making sure we have the right mindset, making sure there's things we can do as the markets go on, as a lot of people maybe are gaining experience in the markets, things that can be done to help out. Especially in the oil trade, given the severity of the way oil trades, both kind of intraday, intra-month, and then within these structural cycles over time. So yeah, I guess we'll just start throwing stuff out there and some of my comments, and then maybe a future spaces discussion here in the near term. Would love to hear other people's opinions and kind of what they thought as the year went on. So, but for the presentation itself here, everything is kind of data driven. So as with the previous presentations, every slide has a picture that kind of agrees with what I'm trying to say to some extent anyway. So a few things up front here. I'm not an investment advisor, so everything I share today is my own opinion, my own insight, my own interpretation of the situation. We did a 2021 options performance review in early 2022, where I went through some of the options that I had entered at that point. There's going to be a little bit of update here, a little bit of overlap from that, but I really wanted to do some of these just to maybe discuss some of the trades and investments. What I find happens in a lot of cases is, people make good or bad trades, and then they, after the fact, come up with explanations as to why it worked out or didn't work out. And that's fine. That's really how life works. History writes itself that way. The victor sort of writes the story. But at the same time, I think it's important to maybe look back and see, okay, why was this trade entered in the first place? And did the risk reward make sense at that time? Were there other kind of factors that should have been taken into account? Looking at things from a pre-entering the trade perspective, as opposed to just going out there and thumping your chest and saying, "Oh, it was a fantastic year and all this," which it was. I'm not going to go against that. So a couple other things up front. Please do your own due diligence. So the investments that I talk about today are in some cases highly risky, very short-term investments / trades. So depending on what your expertise is in the area, your experience, and kind of how you see the sector and the companies themselves. So please do your own due diligence, and please check your own risk tolerance. The way that I run my risk profile in some of these equities and the way that I run the portfolio is possibly a lot different than a lot of people listening, and maybe other investors. So everybody has their style. Everybody has their edge. Everybody has their way of doing things. So just keep that in mind. These things can move very, very fast, especially if you're running three things: margin, options, and junior commodity companies. Very, very torquey things that can move in unison and just become one of those when it rains it pours situation, both on the upside and the downside. So this is something that I maybe will leave to the end of the session, but the negative skew on a lot of things is what I've learned in 2022 was a pretty significant factor in the way that I run my sort of portfolio allocation going forward. So so the third thing that I would look out for is your portfolio construction. The way that I set up my portfolio is on a margin portfolio. I run a pretty up and down options exposure, but longer term. And then the junior company exposure has been ramping up as time goes on throughout 2022 and now into early 2023 as well. So lots there. I also have a mailing list. So if you want the Zoom link invites before we do these, so on the Fridays or the Saturdays, I haven't really shared too many files in these mailing list emails, just because the files are more so private than some of the other ones. But as the sessions go on, I hope to be sending the presentations up front as well, just given kind of when I finish them and when the session is. So if you do want to join that, please just shoot me a DM or an email, and we can get you on there. And then the Zoom session and the Twitter space are recorded as always. Every single thing is recorded, will be available on YouTube. I have been getting a few messages about some sort of mentorship scam going on. So I don't have any programs. I don't charge for anything. So please don't send any money to any accounts. I recently learned they were spoofing my Telegram number somehow. But I guess just not aware of how advanced these things have gotten, where they look legit, completely legit, to the point where you can't even tell them apart, which is obviously why people get scammed and why they're so successful at these things. So, okay, we'll get started. Another quick little reminder for anybody on the Twitter space that would like to join for the Zoom visuals, whitetundra.ca. If you scroll to the bottom under events, you can join us. Otherwise, the audio will work as is. Okay, so let's get started. So one of the kind of things I see here, and I've shared this exact slide before in a presentation last summer or fall, is this this whole narrative-driven things, which the newer entrants to the market and the newer traders have picked up and are just amplifying like crazy because their volume is so high and the number of retail trader compared to kind of their average volume or average transaction size is just there's so much more volume out there for so much less impact, despite the fact that retail investing is becoming a much bigger part, both from a volume standpoint and a size standpoint, as time sort of goes on. So here are some news. What's going on here? So here are some news screenshots that I took about the exact same headline. I just Googled living paycheck to paycheck, and maybe I put America in there. And then I went year by year from 2000 to 2022. And it is the exact same headline with different percentages that don't add up because they're not using the same calculation methodology. They are using different people that they're looking at. Some of them are looking at certain age ranges. But at the end of the day, they've been pumping out the same fear headline for 20 years, possibly even more, previous to the internet. And so I'll just read some of these out. April 2014, middle class living paycheck to paycheck. 2015, January 2015, 55% of US households live paycheck to paycheck. February 2022, half Americans living paycheck to paycheck. June of 2015, this one's pretty interesting. Even millionaires are living paycheck to paycheck. Same thing in 07. In 2019, this is pre-pandemic, they were saying that 78% of workers were living paycheck to paycheck. So the numbers don't really add up. What they're saying doesn't really mean anything because they've been pumping the same thing year after year. And I'll just go through a few more here just to make the point absolutely clear. September 2010, 77% of employees are living paycheck to paycheck. December 2015, 100,000 and up is not enough. Even the rich are living paycheck to paycheck. 03, 08, 2013 was 76%. 2022 became somehow 64%. And then from March 2022 to June 2022, it went down to 41%. So the point I'm trying to make is all of this is just nonsense. It's fluff articles that's put out when they need a bit of content, when they got to rile people up, keep people interested, get their ratings up. It doesn't mean anything. There's an article about Canada as well. So this is not just the US. This is talking about 2013, that 1/3 of Canadians are living paycheck to paycheck. So these things used to mean absolutely nothing. And the investors realize this until now that we've got this post-COVID sort of investment timeframe. And everything once again, everything is just amplified. People start to pick things that support their narrative. And overwhelmingly, I find a lot of people are more so bearish on things than people that are bullish on things. So articles like this are right up their alley because there's no way to disprove it. The research methodology always makes sense. The numbers are correct in the way that they're representing them, but do they mean anything to your investment philosophy? Do they mean anything for your investment time frame? Do they mean it? I don't think so. It's just the same article. And people say, well, it's going to matter when it does. Okay, so show me data that shows why it's different. Just regurgitating the same thing over and over and telling me the consumer is going to die and people are suffering and inflation is killing them. It doesn't mean all that much. So just keep this in mind when you are on some of these spaces, when you're talking to your family and friends, when people say certain things. It's never been easy. The life in America has never been such that every single part of the population is just like bathing in Bentleys and Lamborghinis. It's never been like that. It's always been a very capitalistic environment where there's a pyramid sort of architecture in society. So here's 5 more that I put in about the same thing here on the next slide. 2008, 2009, 2022, and another one in 2022. So really, it doesn't matter whether we were in a recessionary environment, whether we weren't, whether we just came out of a recession, what was happening, they keep pumping out the same article. The same thing is true for recession. Global recession, January 18, 2016, global recession fears bubble up. August 2011, oil drops on recession fears. 2012 November, oil down as U.S. economy fears reemerge. It's the same damn thing every single year, and you might have seen this on some of you're scrolling through oilprice.com or something, and it says oil down on recessionary concerns, and then the next day it says oil up as recessionary concerns ease. Like the economic cycle doesn't work on a day-to-day a movement. It works over multi-month, multi-year, multi-decade a cycle where things add up over time. They ease up over time, and changes just happen across the economy, across the stock market, across demographics, across the way that people work. Of course, COVID being one of the big changes, we still don't know the full impact of it as to how things are going to play out over time in many areas, not just the stock market, but in the health, in the remote work, in the entrepreneurship, the small business, everything. So yeah, the narratives are getting a bit tired, especially when I hear the same thing that was said 12 months ago, and it's being used to make the exact same point, yet the market might be in a different area, or the other data are showing something completely different. So let me get a bit even more into it. So the Chinese property bubble that supposedly is going to burst any day now, and thus China is going to go ex-growth, and 1.4 billion people, along with their politicians and government, will just watch it crash and burn. Seems to be the mandate, and again, the exact same thing. 2010, Beijing's new challenge, post-crisis housing bubble. November 2011, China's housing bubble. December 2004, China's housing price hike, is it reasonable? July 2011, China's housing bubble, new evidence. January 2010, Shanghai real estate is the most obvious bubble ever. Okay. August 2014, real estate bubble in China. And November 2016, how serious is China's housing bubble? 2010, could the bubble burst? 2011, the great property bubble may be popping. Like, people have been trying to call this for year after year after year. April 2012, March 2013, September 2017, May 2012. This is a nonstop ending thing. Has there been a slowdown in the real estate sales, the square footage sales? Sure, 2022 was the first year that China really completely locked down their economy compared to 2020 and 2021, where there was still a lot of activity going on domestically. And all you got to do is look at the number of flights that were operating, the gasoline, traffic congestion, and then just the overall economic indicators and oil consumption that was happening during those times. So, can the property bubble pop? Maybe, but betting your entire investment portfolio in a very short period of time on something like this happening that has been trying to be called out for almost 20 years now, if not more, I personally don't agree with this sort of investment thesis. Looking for black swan events every single month, they don't occur on that regularity, and if they did, they wouldn't be black swan events. So pretty kind of straightforward, I think. And one point that I really want to make, if there's any narrative you see out there that you're wondering what's happening here, why am I hearing about this, what's the real impact of this, all I can suggest, take the exact headline, put it in Google, and put different years after the fact. So put 2004, put 2010, put 2014, and if the same headline is repeating, just read the articles. If there's nothing that's changed since then, per se, then it's a nothing burger. It's just put out to get views, get you hooked into this thing that then goes and spreads like wildfire. Just given the kind of, and I don't mean this in a negative way, but just given the fact that a lot of the retail participants are having less and less expertise or experience in the sector, they're more and more liable to picking up things that's noise as opposed to real signal affecting their investments. So I'll kind of leave that there. If somebody has any other cool ones that they come up with, and there's like tens and tens of articles, please feel free to send them to me, and I'll add them to the future iteration of this exact same message. And why do I say that? Because narratives are going to continue. That's what runs the world. So lo and behold, 6 months later, I'm going to hear the exact same story, that the consumer is suffering. People are living paycheck to paycheck. The economy is collapsing. Nobody has any money. And I'll share this exact same slides that I just did with maybe one or two more. So one other thing that I've been tracking is the FINRA margin debt. So how much margin are people in the US using to trade stocks and equities and other options and whatnot? So this number has come down significantly from about, I believe it's about $1 trillion to about 600 billion now in the scope of 1 year. So I think the very large sustained moves that we saw in 2022, there was a big component of that because of the amount of margin in the system that then got leveraged up even more through some of these crypto schemes and other things, along with some of the brokers offering 7, 8, 10 times leverage on companies like Suncor, which just seems exceptionally risky to me to even offer these things, but that's just the world we live in. So now that this margin debt is down to its, call it pre-COVID level, even lower when you look at the overall trend of sort of money in the system, I don't think it's prudent to just think that there's going to be a huge collapse all of a sudden, because that extra margin, that the money that people didn't have, has come out of the system significantly. And when people reduce margin by $400 billion, that means they've also reduced their other stakes. It's not like they just sold their margin positions, they sold other things as well to get out of that. So a large amount of leverage is outside the system. It helps us somewhat through these like waterfall scenarios that people are projecting, that all of a sudden the NASDAQ or the S&P is going to drop another 40%. Like, could it happen? Sure. But we got to look at everything from an expected value standpoint and the factors that go into it. If this margin debt was continuing higher and it was at $1.2, $1.5 trillion, there would be reason to be concerned that some sort of seize up in the system could really bring down equities really, really fast. That is somewhat mitigated now, given this graph that I see here. So yeah. So I can get into some of the more nuanced stuff. It's not really the point of this presentation, but this is something that I've shared in my macro outlook view pretty substantially, is that just because you have a recession from this steroid fueled COVID money supply 2021 era doesn't mean that you're going to below pre-COVID levels and you're going to suddenly destroy the economy. You could have a slowdown from that and still be on a path that was much, much better than the path we were on in 2019 and 2020. So for sure. And this is a topic that you could talk about for literally years. You could talk about recession and what's happening and all this. So I'll just leave it for now, but happy to kind of touch more on it over spaces or something else. So, and yes, Damien says margin is also more expensive. That's why it's down. And I'll share my personal experience with this. You can see this exact point made very clearly on the chart. So here's WTI oil over the last 18 months or so. And you can see how there's very, very sudden and sharp moves throughout the last 18 months. This is not something that's new, that things are going up and down like this. There's been a lot of political interference, a lot of paper market activity, maybe more so than even we were used to. There's a lot of chefs in the kitchen. There's the US administration, there is Iran, there's OPEC, there's Russia, there's China, India as well. So a lot of moving parts, lots of ups and downs, but for the most part, these sudden drops that are unexplained have been pretty decent buying opportunities. I will share here why this November 2022 a drawdown based on Omicron was pretty much the best time that I've had investing, picking really good relative outperformers, and then all up along the way. Really not that great entry points, but at the same time, when you look at things from a higher out, zoomed out view, a lot of the equities are still trading today higher than they were in March, April, even the early parts of May of 2022. So they still ended up being pretty nice buying points. And then as we go down here, obviously we know the late September drawdown we had, and then the kind of November, December complete washout that also occurred. So, just keep this chart in mind. There's no rush, I don't think, to enter anything. There's no rush to really sell anything. From my perspective, I kind of watch the action as it goes on, depending on my portfolio construction, what's in it, how much margin room do I have as well, really affects things. But, when you look at this chart, what you see is, if you think you missed an entry point, for the last little bit anyways, there's been more down the road. If you think you missed a top high chance to sell, there's been other ones that come not long after. So getting our mental health all messed up because of 1 week movements, when we see this pattern of this very jagged up and down pattern occurring, I think is maybe something to think about. We have these very detailed discussions on the down weeks as to what's happening, why there's so much drawdown, why these things are happening. And it ends up that although there's a sense of calm that everybody has after these things, there's nothing really that's garnered at the end of the day. We're just in this very illiquid pattern in WTI. There's not that many market participants, and there's a lot of major moving factors that are happening on the global scale, which can affect things along with paper market trading, which becomes even tougher when interest rates are higher, because there's more that you have to pay to play to be in the game per se. And people may not take opportunities where the risk reward is not completely obvious. So yeah, definitely want to track here as things go on. So I'll share one success story from the 2000 to 2007 cycle, one of the really well-known success stories during that time, Pato, of course, and a company that nobody believed in. They said the co-founders and the founders are, for lack of a better term, jerks. I think there's an article that was put out to that, and nobody believed in them. People wanted them to go bankrupt. They were this wild, kind of really aggressive team that had potentially discovered a new acreage. They were going to develop this acreage, and then also took advantage of this bullish cycle in gas and oil that happened from kind of the early 2000s until 07, 08. And those are kind of very similar factors that we see right now. We see companies that are beaten down, trading at very low cash flows, cash flow multiples. We see them entering into this structurally solid market for the next few years. And at the same time, some of them have growth plans, they have redevelopment plans, they have re-optimization or optimization plans where they can bring production up, which then naturally drives this cash flow on steroids kind of scenario. But the one thing you see is none of these companies went up 40, 50, 60x in a year. These companies take 2 to 3 to 5 years to let them develop over time as things go on, let them reinvest that cash flow back in the company and accelerate the company's overall profile. So what's changed this time around? Why is this cycle a tiny bit different? The reason is COVID. What COVID gave many of us who are in this room here with me today listening and on the Twitter spaces, what it allowed us to do is before we even entered this call it cycle, we've been able to 10, 20, 30, in some cases 50x our initial capital. So we're entering the real meat of the cycle with a lot more capital that was expected, to people who were in the oil trade in, call it, late 2018, and then again in late 2019, where we saw glimpses of the oil supply demand sort of changing. So from that perspective, it brings about challenges and it brings about good things. So the good thing is that because there's a lot more capital that some people are starting off with, you're able to allocate accordingly and take bigger stakes, bigger positions. You're able to maybe have these visions of even higher gains from here, and you have an ability to be patient because you've already taken part in a lot of this part of the cycle, as shown on the chart here, and now we're just consolidating here. as we decide, okay, what's going to happen now to global markets as the data comes in. And a lot of the data has been, I think, very constructive over the last 12 months. But again, not investment advice, my opinion. The bad thing that's happened with this is that the money numbers that people are playing with these days is maybe a lot larger than they've ever played with before. I should say invested with before, and it can lead to some serious psychological things that need to be taken into account. So just keep that in mind. When the numbers get bigger, there's more to think about. There's different other things that come into play. The whole mentality around losing a trade is a lot more painful than the joy of winning a trade, et cetera, et cetera. There's lots of psychological studies that have been done around this subject, so I won't really get into it. But really, these cycles are what makes things fun. And if we go a little bit further into it, the reason people invest in oil, from my perspective, that I'm in the oil trade, may not apply to other people, is that I'm here to hit home runs and grand slams. I cannot deal with the volatility in oil and have to follow supply demand on this $10 trillion market, deal with people who are trying to actively destroy the price of oil, deal with the social backlash of investing in these companies and whatnot, if I'm not in it for home runs and grand slams. And what happens every oil cycle is when that structurally bullish cycle starts, you have companies that go up 10, 20, 50, 100x. And I'm talking from here onwards, not from the lows of COVID. I'm talking from here onwards. There's companies that are going to do that. And if you have the ability to kind of time companies, as in figure out which ones are going to have inflection points earlier, which ones are going to outperform their peers, you could end up making 1,000x plus in these sorts of markets, just because, as I mentioned, these companies take 2 to 3 to 5 years to build out. If you get into some company that's very early in that and can really accelerate, use that, whatever X you got on that, redeploy into another junior that's just starting off, and then that goes up X, some X, and then you then redeploy that. You can see how the compounding effect really starts to increase the kind of life-changing potential, not even life-changing potential, like I'm talking being able to buy yachts, kind of building a wealth mentality. That's the reason people invest in the commodity space to begin with as retail investors, because there's definitely an edge you can get. So anyway, I'm kind of digressing here. So on Payto itself, if you look at the chart, you kind of see what's happened here. So from 2000 to mid 2001, there's a massive run up here in this stock. I can't quite tell how much exactly, but maybe a 3 to 4x in 18 months. And then it dropped. Over the next 6 months, it proceeded to drop 50%, from about $2 a share to $1 a share. That was late 2021. And then what happened after that? We had about a 6-year bullish oil and gas cycle. And the shares went all the way from $1 to looks like about $35. So about a 35x in a 5 to 6 year period. So sounds pretty familiar, doesn't it? There's an 18-month bull run, then there's a consolidation phase, and about a 6-month drawdown where the stock doesn't just drop, it drops 50%. And I'm sure people were victory lapping and partying in the streets that, hey, we finally got him. We finally saw it drop 50%. You're a sucker for not selling at the high, not realizing that the stock had went up 4x before dropping 50%. So the investors were still up 100%, and then it proceeded to 33x in the next 5 years. So am I saying every company is going to happen? Is this going to happen to? No. What I'm saying is we invest based on this sort of playing out over time. The macro, obviously, people know my views on the macro, and that I support this sort of structural thesis coming along over the next few years. And then you pick the companies that are most set up to kind of fit your investment style. For some cases, in the case of my portfolio allocation, is built on upside torque. So I don't really look at downside protection. I look at the upside torque as to what I'm getting on these names. Not every name is a $120 bet. There are names that are, do really good in $80, $85 oil. but I'm definitely not running sensitivities at $50, $60, $70 oil by any means, because if I thought that was happening, I would sell everything that day and just let the market play out and then re-enter. But I don't see it any sort of sustained activity there at this point in time. So a couple more slides on the narratives before we get into the actual presentation that I was, I guess, supposed to do here. So we see this big thinking, oh my God, the EIA report is saying crude is going up. It's building in the US. Therefore, we must have a glut globally. And that's it. The energy crisis is over. And, there's don't even try talking me into it. It's over, right? That's what I'm seeing on certain few kind of, I call it chat rooms and spaces and whatnot. Well, the people that are saying these things don't have the other side of the data, which is that Chinese inventories were down 21 million barrels last week. They're down 27 million barrels in the last 1 month. So when you have crude builds in a certain area, you always got to look what's actually happening across the world. We cannot just pick one number and give it more or less importance, kind of depending on what the number is. When overall crude in the US was drawing, it was like, oh, it doesn't even matter. Like it's all SPR crude. It doesn't matter if we're down 220 million. But now that commercial crude is up 30, 40, 50 million, all of a sudden there's this huge impact emphasis given to that. So just keep an eye out for other things. Keep an eye out for individuals who are misleading, specifically with one part of the data, not showing what's happening in other parts of the world. I myself am guilty of this in certain cases where I was caught off guard, for example, with the number of Chinese product stocks that they had built up over the years. Got my own views on that as to how that affects the markets, but the data was one that I didn't have at the time, at least to the accuracy that was then later put out. So, just keep these things in mind. The other thing I'll talk about is the rig count in the US. It's not just that the rig count is dropping, it's that the number of counties that the rigs are in is dropping. So, which gives me an overall sense that the marginal acreage that companies had started to exploit in May, June, July, August, it's all gotten pulled back. We're now at the number of counties that we were in early 2022. So we've come full circle, and really, really bad for oil supply going forward. When you have volatility, when you have instability, when you have break-evens going higher, when you have inflation, it's just very difficult for these companies to have any sort of sustained development plan, especially, like I said, when they're running out of acreage. As I discussed last week, they don't want to blow this acreage in a $75 environment. And we are exactly flip-flopping between this range where it doesn't make sense to keep these rigs running. And you see that in the data. This is the real lagging data indicator that I think, are some of the things that are really important, where we see a distinct loss of oil supply and oil capex, especially in shale, which is without the capex, you see production is going to decline very, very fast on its own. So you almost can't afford to have a slowdown in rigs, because that leads to an accelerated slowdown in the overall production profile. So things that are happening underlying, second order, third order impacts, which you can be bullish and bearish on where WTI is. You can be bullish or bearish on where the oil equities are, where XLE is. But I can tell you for sure, there's things happening behind the scenes that people aren't really putting into their models. They're more of a reactionary kind of investment or narrative, as opposed to a proactive based on the data that's coming out, which is pretty obvious. It's telling you what's happening as things come in. There's no need to speculate. Our rig's going to be 650 or 750 by December. We can see the trend happening and just make interpretations as we go, rather than stress ourselves out with trying to project things way out in advance, right? There was a Twitter post I saw the other day, not to pick on any individual, but the post was literally discussing what the price of LNG is going to be once it's in the global markets. Like, it is so far in the future that how can you say or make these statements with any sort of accuracy? And does it even really matter to your investment thesis at this point, right? So one of the things that I've been noticing, one of the things that I learned in 2022 is just focus on the data as it's coming in. Yes, have an overall macro view on where things are going from a cycle perspective, but to make like absolutionist comments on what the rig count is going to be or what kind of multiple we're going to exactly reach in 6 months, it doesn't mean anything because it's just opinion at that point for the most part. But if you know, from my perspective, if I invest cheap enough, if I invest in companies that are trading at very low multiples, that are trading at a point when the WTI price is lower, I give myself a better risk-reward mentality, risk-reward probability, and just go off that and just let the cycle do the talking, let the performance do the talking, rather than kind of getting caught in these day-to-day arguments as to what's going on and whether it really impacts the sort of trade. I understand these are very cool things that we like to discuss, being we are oil and gas, heavily oil and gas invested. So from that standpoint, of course, it just makes sense to throw out ideas, discuss things, make interpretations, have a back and forth. That's really what makes the whole journey interesting. But I think as far as kind of investment strategies, maybe a bit too much noise, even within the oil sector. And again, this is just my opinion. More than happy to hear pushback on this, maybe on a space here in the future when we all can get together and maybe share our thoughts on these topics. Okay, so we'll get into the actual presentation here. Just before I begin, a quick reminder, anybody on the Twitter space that would like to join for the visuals, the Zoom visuals, whitetundra.ca. If you scroll to the bottom under events, the Zoom link is in there and you can join in. If not, feel free to keep listening in to the audio on Spaces. Okay, right on. So there's a comment here. Yeah, so the question here is on why China had to pull from the storage. So China in the last 2 weeks of January had a slowdown in the number of imported seaborne crude imports, along with their refinery utilization going really, really high. And they just made a point the other day that they're not going to be able to export as much products because their internal consumption is so high. So quite a few things happening there. I think seaborne imports were lower because the late January import schedule would have been booked around, call it late November, early December, when there was this opening in China, and then they again had this kind of complete a seize up as everybody got sick. And there was finally some clarification as to how things were going to happen. So watching that play out, just keep in mind, crude takes about 4 to 6 to 8 weeks to show up in China. So everything there is sort of pre-arranged and can't just be adjusted on the fly. There's a lag effect to that to begin with. And then the refinery utilization going high, I think was pretty well projected. There's a lot of information coming out on that, on the product export quotas. The messaging that their internal consumption is really high is definitely new data, and one that really isn't being taken seriously, I think, so far. So China is still a show me story, and we're going to watch it play out over time. I've been relatively pleased so far with how things have kind of gone, especially with international fuel, international jet travel, which I think is really the big proxy to watch here for overall Asian demand and growth this year. So, but yeah, appreciate the question there. So coming back to our actual trades and investments and what happened. So the first one that I want to talk about is the Suncor January 2024 US dollar 20 options. So I bought these in October of 2021. So bought myself about 27 months of time on this, really stretched it out. The reason being, in late 2021, there was not the same level of clarity that we have now. There's questions on US shale, there's questions on OPEC spare capacity, there's questions on the Omicron. This was even before Omicron. There's questions as to what was going to happen. Excuse me. And then, of course, Omicron hit, which caused even more confusion amongst the space. So anyway, I gave myself enough time, bought it when Suncor was about $22.5 USD, sold it in about 5 months. Suncor went up 36% during that time. The option was up 74%. I paid about an 18% premium upfront. So pretty good return there. Very nice, stable return on a company that was undervalued at the time, I think, had kind of restarted their buybacks. I believe the dividend was kind of imminent as well. After Suncor had cut it during when COVID first happened. So lots of nice catalysts. Overall oil price obviously helped. And it was just a nice play overall. Not the most torqued up play by any means, but gave me a little bit of confidence in the options market after I'd begun trading options in kind of call it mid to late October in 2021. And just a nice play. Like when I look at options, it's not always that I'm trying to relatively outperform everything in its peer group, but if something has a much lower downside risk and has a similar to slightly lower upside risk, I will take those sorts of bets in the options market because of the inbuilt leverage that I have anyway trading these instruments. So when we look at where Suncor was in late 2021, its peers had done really quite well. Its peers Imperial, CNRL had a fantastic 2021. Cenovus as well was at this point just in its ramp up phase, where Suncor was still really, really lagging below its pre-COVID high. So at a time where their kind of return of cash to shareholders plan was going to be implemented in a very aggressive fashion. So bought this with a very kind of little downside risk. The only way I could have lost money on this is if in January of 2024, Suncor was below $26.5 US. So effectively what I'm saying is I had 27 months for Suncor to go up 18% for me to break even. And with my view on oil that I had in October 2021, that was a really, really good bet. And I think this is one of the edges that the oil investor has lost in the last 12 months is there's too much option activity, and some of these really, call it not low risk, I'll say high floor, high ceiling bets are gone. People are just piling into these things when they see these arbitrage opportunities, when they see an opportunity to almost rent a stock for multiple years, paying very little premium upfront, and still partaking in the upside torque should things go according to plan. So, from that standpoint, it's just too bad that we've lost these. But I still think if somebody is willing to spend the time to actively track these markets, especially on big down days, I still think there are opportunities out there. For me, it just hasn't been as attractive, and I'll talk more about this as I go on. It just hasn't been as attractive because the option premiums have gone up quite significantly. The other one I'll talk about is the Crescent Point April 2022 $5 options. So I bought these in late December when Crescent Point, for no reason whatsoever, diverged from their peer group. They were just getting slaughtered in late December. Mid-December, there was some speculation that it was to do with Shell dumping their stake from the Kbop acquisition. One to really keep in mind, if there's companies that have done acquisitions and they have 4, 8, 12-month periods that are lockup periods, there's some really nice opportunities that one can get around those times when there's huge blocks of shares entering the market and providing this upside pressure, downside pressure, selling pressure on the stock, because these are just things that are going to pass. The market just isn't big enough to absorb these sorts of blocks. At this time, Shell had 50 million shares, if I'm not mistaken, in Crescent Point. So, about 7-8% of the float, and 50 million shares would have been roughly, call it, about $400 million US, $350 to $400 million US. The market was not going to absorb, or $350 to $400 million Canadian. The market was not going to absorb this sort of massive volume in December 2021 when there's no real movement in the price of oil until the new year came about. So I piled into this. This was one of my most aggressive trades I've done on the options market. This was kind of when I had a couple months into it. I was really looking deeply into things. I don't look at the Greeks. I don't look at the implied volatility. I don't look at any of those things. I just look at it. What am I paying to buy this stock on the expiry date? That's all I look at. And if the price goes to this is my expected return on this sort of investment. That's basically how I look at options. It's a different way to trade equity as opposed to any way to hedge myself or add leverage or add torque. It inherently adds leverage and torque, but that's not the main reason for doing this. I just said, hey, in April, do I want to buy Crescent Point for $5 US? Yes. Am I willing to pay 72 cents up front to do that? Sure. I think that's a really good risk reward. I only paid a 10% premium on this and gave myself about four months or so when I knew the market was looking really strong. Omicron had kind of fizzled out. Some of the data around Omicron was showing, oh my God, this is the one that's going to end COVID because it's so transmissive, yet the death rate is so low. The stock itself went up about 47% during that time frame, including about a 20 or 30 day in a row green streak that it had in January, and the option went up 261%. This was actually one that I'm really launched my ability to reallocate these funds. It was about a low six-figure gain here, as you see on just this option. And again, you make 261% in a 4-month time frame. You can now reallocate this, make another X percentage over the next year, and that's where we sit today. And now that compounding effect has resulted in people, not just me. This is not just me. This is people who have taken on these kinds of trades to say, hey, I can 100x, this cycle. If you look at it from, call it 2020, January 1st, 2022 onward, there's a legit case that can be made that people are going to end up with that sort of performance. And that's after the easy money was made in 2020 and 2021. So people ask me, why are you so bullish on oil? Like, why is this something that just captivates you and just eats you up day to day? Why are you willing to make this your lifestyle as opposed to other industries? And it's literally this: when the cycles change and the structural cycle comes, there's always people that have made money that is unbelievable of sorts, and it doesn't take any sort of huge, call it multi-decade patience either, like some of these tech stocks. So anyway, I'm obviously bullish on this sector. So take everything that I say. It's my own opinion. Please do your own due diligence on how you see things and your own risk tolerance as well. There's ups and there's downs. With Crescent Point, I figured I was buying things very, very cheap. The high floor, high ceiling nature of things at the time. Lo and behold, we are today sitting at a WTI price that's very similar to what it was in December of 2021. So, I guess I'll just throw that out there as well. So here's a Crescent Point chart. You've seen what's happened. Like, there was a uptick in December, similar to their peers. Once the Omicron was known what was happening there, and then it fell. It fell about 10, 12, 15% from December 13th to December 18th. Why? No reasoning. There's nothing really that happened. Its peers didn't have this same sort of pattern, at least not to this extent. So I waited for the pattern to kind of reestablish itself a little bit higher. Could I have gone the options a lot cheaper? Sure. At one point, yes. But remember, mid-December, although I was convinced in the Omicron data not being serious, that doesn't mean that world governments weren't. They could have easily come in and completely lock down the entire world yet again. And then your fundamentals don't matter. Your death rate doesn't matter at that point. So waited for the little bit of an uptick, a little bit of a bounce back. The hospitalization data from South Africa came out really, really fast. It was being updated daily. And, I was quite contrarian, I guess, maybe to some of the other personalities on Twitter who figured that this pandemic, Omicron, was going to be the end of humanity and whatnot. And I believe a lot of people were. The data was not showing that this was a deadly strain of the virus, very transmissive, not deadly. And then you can see what happened to Crescent Point. I mentioned the 20 or 30 days of continuous green pressure that happened there during January and early February as well, I believe. And just to give you an idea, when I talk about compounding as well, Athabasca oil in 2021 onwards, call it November 2020 to April, May, June of 2021, I had a very, very similar gain. About 95+% of my portfolio was in Athabasca at the time. I had bought in very, very early. I think my average was around 13 or 14 cents, maybe even lower. This is before Eric Nuttall even got involved, and just sat there. I just sat there in that trade. I said, I don't need to do anything. I just need to buy something that's completely beaten up, where the debt issue is not imminent. Yes, it's coming, but it's not like next month either. And I just sat on it. And I think people know this pretty well. Athabasca proceeded to just about, I want to say, 7x in a matter of 6 months, from early 2021 to mid 2021. So again, this is what makes the oil market so fascinating. The compounding effect and the lag on these is just such a more surefire way, I think, to generate these compounding returns and performances, because all you got to focus on is oil macro, and then look at the companies that make sense within it, as opposed to some other sectors where each company, yes, it can compound, but they have different valuation metrics, they have different subsectors, they have different research that needs to be done into them, which really takes up a lot of time. And yeah, I guess I won't really get into it because it's not my expertise tech anyway, so I wouldn't be going into it regardless. Yeah, so when I look at premium paid, of course, I don't want to pay huge premiums. The premiums I'm seeing these days are in the 30 to 40% range in certain cases. Those can still be worth it if the upside is big enough, as in when you run the numbers as to what could happen. Do you have a 5, 6, 7x potential? Maybe it's worth it, but I do like options I can get into under 20% premium, 20, 25%, even lower if possible, because it's just a high floor, high ceiling bet. My break-even price is lower, and then I get more upside torque just because I paid less upfront. So, that's how the Crescent Point kind of ended up happening. Just timed it somehow really well, despite the fact that Crescent Point itself was up about 10% in the last 10 days before I bought the option. So I already paid up, I still got a really good premium on it. And then, of course, we saw kind of what happened there. So yeah, and tax loss selling as well. Yeah, December tax loss selling is a great time to take advantage of some of these options activity, because people are selling without really paying attention to what's happening, or they don't care. And as we've gone to learn here in the oil markets, it's just not liquid. There's not enough market participation to value these companies at this point to what they really should be valued at. And there's short-term dislocations relatively that can happen as well, which create great buying opportunities if people have the cash and they're sort of willing to have a plan up front. So another one, I don't want to really go through every single one in detail. This was another Cenovus option, June 2022. Couldn't have been timed, I guess, any better in hindsight. Luck of the draw. Paid about 19% premium. The stock went up 42%. The option went up 208% over a 3-month period. So, really, really solid. One of the reasons I've stopped playing, stopped buying so many options is because I just don't see the same level of high floor, high ceiling bets. The premiums are much higher, but also the ability to make these very, very quick gains, I think was a lot more obvious in December 2021, as opposed to where it is right now, just given the kind of the fact that I think there's a case to be made that as oil prices rise, because the equities have outperformed by such a large margin, the equities may not actually catch up until price of oil sustains $90, $95, $100 plus. There's a bit of a gap in here where the crude price itself going up may not reflect in the equity prices going up to the same amount, just given that the equities have vastly outperformed over the last 6-month period. So my own working theory doesn't mean it's going to happen exactly like that. Funds flow can change in a hurry, but I'm just not convinced that a $10 move in oil price here is going to result in a corresponding gain in the equities as much as an oil price move from, call it 95 to 105 would at some point in the future here this year. So my own view, I'm more, I'd rather pay up. Like I'll rather wait for the equities to go up and then buy options if I see that the equity versus commodity correlation is going to be a lot stronger at that point in time. So yeah, I mean it's a brutal game, this options game in the oil market. Like there's so much things being manipulated. There is all these band-aids, and as I mentioned earlier, chefs in the kitchen that are coming in, that like the option has to be almost a grand slam trade for me to enter it. I don't just enter options for the sake of entering them or playing earnings or whatever else. They're entered for a reason. And a lot of the times I enter option trades on equities that I already own. So what I'll do is I'll enter the option and then trim back some of my equity exposure, which gives me a very different kind of leverage with, in some cases, very, very minor increase in risk or premium paid. Yeah, so this question I kind of think about every so often is, what would happen if I just left Athabasca in there and it ran up to $2-3, and there's some talk right now that Eric's got a target of $6 to $7, and what that would end up at given my sort of portfolio allocation. And I think these are really, really interesting questions because, once again, it's the victor who writes history. So it's easy to say these things given where we are now, but let me ask you this question a different way. What if in March of 2021, for some reason, the Biden administration got way ahead of itself and started to launch the SPR very, very at a very low, call it oil pricing, right? What if there was a huge, some other macro factor that came in, and then Athabasca had debt due in February of 2022? Doesn't sound like a very prudent thing to be doing, holding those names when they were up 2, 3, 4, 500% in some cases. There's the opportunity there to arbitrage the gain in Athabasca and flip it into other positions which hadn't gone up as much from my perspective. Did it play out that way? No, WTI kept ramping up all throughout 2021. Athabasca itself kept ramping up and maintained this 80 cent to $1 range that it was in about that 2018 timeframe. So things played out differently, but looking at everything and trying to analyze it in hindsight may not be the best way to look at things because things do change. And I definitely would not have been comfortable with Athabasca if oil prices went just a little bit down in 2021. And then there was this looming debt refinancing at a time when I absolutely hated management's ability to really execute on some of these transactions. So yeah, I guess it's definitely one that we can think about. And would my portfolio have been higher? I think marginally. I'm not entirely sure, but at the same time, there is a case that can be made that to just buy and hold for multiple years, and maybe you end up better. And I know, for example, Razor has been doing really good work. Razor Oil has been doing really good work on kind of looking at the differences between companies within the sector and their correlations. And maybe it's just easier to just buy one name and just ride the entire cycle through it. And we're going to find out in a few years whether that was really the case, because once again, the victor writes history and the market does the talking. So yeah, we'll find out sooner or later. Okay, so I talked about the Cenovus option. So here's one that really was good for me. The Suncor June 2022 US $25 option. So I bought this at the same day as the other Suncor option, but I bought this one out of the money. So the other one was about $2.50 in the money. This was about $2.50, call it 10% out of the money. Definitely got a better premium on it, obviously, because it's out of the money. And I also went a little bit shorter in my time. I went only 6 months out, 6 to 9 months out, and said, you know what, if things are going to go up in the oil market, after we saw the price action in 2021, where it was kind of largely a momentum trade, I thought, okay, 2022, the funds flow has to come back into the big names. We're already seeing it in CNRL, in Cenovus, in Imperial, Exxon, I think was one as well that got kicked out of the Dow Jones around this time, if I'm not mistaken. And I said Suncor is the one that's just going to do really well here. They've got the refining exposure, they've got the diesel, they've got the upstream production that they're bringing back online slowly, and things are just looking good. And it did play out exactly like that. The stock went up 63% in about a 6-month time frame. The option was up 413%. So quite happy with the performance. And I think, you know, it just goes to show the difference that people can have about the same company. There's a lot of individuals, possibly on this chat or on Twitter, that will say, oh, I don't want to buy Suncor ever again. The thing never moves. Nothing happens to it. It's just dead money. Well, I'm just showing you the option went up 413% in 6 months. So when you see names like this that are beaten down, that people don't want, they make up, not make up, they justifiably have reasons to not enter the name. If you can just look at timing the market, let it consolidate in a phase for a long, long time, and then it starts trading cheaper versus its peers, buy something a bit out of the money, and things can do really, really well. I'm not saying buy something for next week. I'm saying still, I gave myself 4, 5, 6, 7 months, and I bought it when it was a high floor, high ceiling bet, and things just panned out really, really well. Obviously, I sold this in April. If I would have sold this in, call it, early June, this thing could have been a 10x bet, possibly. Not entirely sure right now what Suncor went to on the US side, but I think it would have been pretty close to being about a 10x in 6 months. And that's how I enter my options. Is I say, okay, I need to have an outside chance at a 10x on this position in the time frame that I'm buying it for. And in this case, it would have panned out. I just sold it early. Late April, I wanted to reallocate into other things. My Suncor equity position had gone pretty large, given that it was on a 30% margin position. So I'm getting 3.5 times torque on the share price through that. So definitely reduced my exposure. As I'd mentioned earlier, a lot of the options I buy are on the equities I already own. So if things move in unison, there's a case to be made to selling these options early before expiry and just locking in that gain and then leaving the equity ride per se. Yeah, I'll talk about Whitecap actually here as well, quite a bit in detail, because this is one name that I think I've got a lot of learnings from, both positive and negative, playing the Whitecap options overall. So it is coming here. I will get to it. Here's my complete loss I had. So Grand Tierra, August 2022, US $2 option. It was bought in December. No, this is the wrong data here. I must not have updated the slide, but I ended up buying this in the euphoria of June, where just after June, the price started coming down. We were kind of banking on, okay, what's going to happen here? Are we going to have another leg up? Are we going to stabilize here? Or are we going to go down? And I bought some Grand Tierra options, which on a relative basis was trading very, very cheap, but made the cardinal mistake, which is I only gave myself 2 months and just not enough time. The SPR was releasing massively at the time. Russian barrels, we saw very, very early indications that Russian barrels were not impacted so far. We saw China have its kind of major lockdown during this time. We also saw Libyan barrels re-enter the market. after being down in, call it April, May, June, and just overall a little bit of demand destruction as well, as product prices had gone through the roof with the crack spreads where they were. So in hindsight, keep your cool when things are euphoric. When things come down a little bit off that euphoria high, there's no reason to rush into buying more equities or reallocating capital. This was a major mistake that was made. Pretty significant capital here was lost. I went in quite aggressively into this name. It was a financially leveraged name, which goes both ways. You either make a lot of money on options if things go your way, or you effectively zero yourself out. So when I entered this, I entered it with a full knowledge that this thing could become a zero in 2 months. But on the other side, if WTI stayed at $125 a barrel US and Grand Tierra was trading where it was, this thing could have been a 5 to 10x play in 2 months. And it's too bad I didn't update these numbers. I don't know, maybe got a previous version here, but either way, I think this is a name that still to this day really captivates me, just given the inherent torque on it and the fact that it's so financially leveraged and the fact that it's a dollar stock to begin with. So now you're buying options on a stock that's $1 to begin with. And you can see how it becomes very attractive. You can make a lot of money, but it's also one that you can continue chasing month after month and just get smashed, So I'm looking a bit further out at this point, as I'm sure a lot of people are, which I see in the comments here. So very, very interesting little play. Obviously, the lesson here is give myself more time. And to make things worse, I had 2 of these options. I had in November 2022 as well, which was about a 5-month option, expired worthless. So pretty serious mistakes here were made on these 2. Specifically, I think overexposing myself to one name as well. And then just the fact that what's unfortunate about these kinds of entries is that if it goes down after you enter, you're effectively stuck. It's really hard to sell them at down 40 or 50% because the upside at that point makes even more sense as an entry point. And you're not going to average down because the position itself was too big to begin with. So really one of my sort of failures, I think, of 2022 was not keeping my cool after a really good run in the options markets and a really good run in the overall markets. And some of the loss that I took post June 8th was mitigated by the fact that I had a really good investments post June as well. So I'll talk about these as I go on. But what made things counteract that entire thing and what I thought to be pretty decent portfolio management was that there's these couple or 3 or 4 trades that, because the capital loss was 100%, really impacted the overall performance for the latter half of the year. Really unfortunate the way that played out, and one that I'm really taking seriously as time goes on is to not have these 100% capital loss events, which can really impact your overall performance, not just from a percentage standpoint, but also from having that capital to reallocate at the lows, as we saw in September and November and December of 2022. So I trade both Canadian and US options, mostly on the US side. I will trade the odd ones Canadian, like a Whitecap, a Tamarack, couple other ones I believe as well. But for the most part, the US ones are just way better liquidity, way more open interest, and just better overall bid ask. But certain names, as you know, don't trade on the NYSE, so you can't buy options for them on the Canadian. You can't buy options for them on the US exchange. Yeah, I'm still watching the Grand Tierra 2024 calls. The Colombian tax is a bit worrisome to me, and the constant bashing of their oil industry, despite the fact that a lot of them have exploration acreage already. I just don't like the political scheme there right now. That being said, I would be lying if I said I don't look at the Gran Tierra 2024 calls and even the 2025 calls now on a pretty regular basis, looking for an entry point. So this is really the reality of the market. It doesn't mean it's a dud, but if I can give myself till January 2025, which is significant time, 24 months, and it allows time for that Colombian windfall tax to roll off, assuming they're not going to extend that, case to be made. This is a company that's buying back shares. They bought back their debt, I believe, at 7 or 14% off market. So, pretty active management team that's working hard, but not quite ready just yet. So, yeah, for sure. You can call it a mistake. You can call it a bad beat. You can call it, a loss. I kind of have thought about these things before that, hey, maybe you were correct and it just didn't pan out. But the reality of investing is the market is your scoreboard. And when you zero out options, the market rather brutally tells you were wrong. So the main thing is just adjusting your investment thesis off that, making good learnings off that, trying to figure out how to adjust and kind of go off there. As my friend once again Razor Oil says, regret is a wasted emotion. So there's no point regretting these things. You kind of live and learn. You own up to what you've done, and some trades that work out obviously make up for the losses. So on the overall, it was still a fantastic 2022. I'm not even gonna try and downplay it. I think 2022 was really good for a lot of oil investors, all things taken into account, especially those who were in the trade since 2021 or even earlier. On a portfolio percentage basis, do you remember what you had allocated to your GTE trades? I think both of these positions were roughly 1.5% of my combined White Tundra plus personal portfolios. So call it 3% total, which effectively, let me put it this way. The entire portfolio, after being up about 339% from January 1st to June 8th, fell 50% until the rest of the year. So when you have a 3% allocation at the high, you can see how that becomes a much bigger impact once your overall portfolio number kind of deteriorated on the overall as the market went on. The dollar loss of 3% at the top now became a dollar loss of 6% at the bottom. So pretty significant impact for sure, especially when I add it to some of the other ones that I'll be discussing here as I go on. So there's another question here. My option allocation right now is like sub 1% at this point. On the White Tundra portfolio, I still am a little bit more aggressive on my personal side, but just keep in mind my personal portfolio is like 5 to 7% the size of the White Tundra portfolio. So having a higher percentage allocation there doesn't necessarily translate to the same dollar allocation. So a couple wins that made up for it. So the Vermilion option that I've held for over a year, December 2022, $15. Bought it almost exactly 1 year earlier. Paid about 54% premium on this. Yes, 54% premium, which is why even though the stock went up 56% in this time frame, I only got a 25% gain on the option. Keep in mind, Vermilion, when I sold it in December, the option was just got smashed. So this option was at some point up 600 to 700%, which made up for the premium that was paid. Once again, a lack of proper timing around the exit point was a pretty significant error here. That being said, the main point I want to make here is that despite everything going wrong for Vermilion over a 3 to 4 month period after August, September, the option still ended up in the green. When I say high floor, high ceiling, I mean it. If you buy early enough, you buy the right kind of option, you do your calculations, you put in the work, they effectively become like a free cash holding with this monumental upside on it as we saw in the other Vermilion option I had, which was bought at a very similar time, held it for about 12 and a half months, and premium paid about 26% upfront, not as out of the money. The stock went up 70% and the option was up 175%. So once again, did quite well here. This option also was up 600, 700, 800% at some point there. But hey, I'll take 175% over a year. Could it have been higher? Sure. Could the European situation have gone a completely different way and the option could have been up 20x? Yeah, you could definitely make a case for that at the time. So if China didn't lock down just as Europe was refilling their inventories and China started buying a whole ton of LNG at the same time, what could have happened? What if Freeport came online 6 months earlier? What could have happened? We don't really know how things would have played out. But buying early, buying cheap, despite some people's qualms about it, gives you an opportunity to be completely wrong. Everything goes wrong on the overall macro side. You have egregious windfall taxes placed. You have their own production dropping. You see them stopping the share buyback. You see them not able to execute really time effectively on the Leucrotta pad so far. You see the Croatia gas being pushed back. We see the Corrib unable to close so far, and you still made 175% in a year, right? That's what I look for when I look for these options, is high floor, high ceiling. I keep repeating myself like a broken clock, but when I see opportunities like this and I give myself a year, 6 months, 9 months, a year, feeling really, really good from that standpoint. Of course, if the entire globe collapses and credit seizes up and all the banks go bankrupt, it doesn't matter anyway. So why exactly do we keep looking at scenarios like that and trying to bake them into our calculations? If there was a real chance of that happening, everything's going to be destroyed. So it doesn't even matter at that point. So yeah, and I am watching Vermilion again. As I mentioned, the option premiums are really, really high right now, as well as just the fact that given that my portfolio is on margin, I just cannot have Vermilion equity as a top 3, top 5 position. It's way too volatile, both ways, up and down, and creates a little bit more difficulty around a margin portfolio as opposed to maybe a cash portfolio, which is why I'd rather have options. But as I said, tracking as I go, watching very closely, including Exxon's lawsuit against the windfall tax, which should be interesting to follow as time goes on here. And I don't have the latest on that. It's just something I kind of tracking on the side when I get pretty serious to enter here. Yeah, I mean, my main expertise is in oil. I like investing in oil. I like focusing on oil. The macro is a lot clearer. The supply and demand is a lot clearer. And yeah, I don't really have all that many gassy names. Maybe there's a misconception here, but my top 5 are all oil focused. Crew Energy is yes a gassy name, but I still picked something with land value and this like whole Montney play kind of overlying the entire company. And the rest of the names are pretty significantly oil weighted, including MEG. My largest position is 100% oil. So yeah, there are some other smaller names that are more gas focused, but they have different investment theses as opposed to strictly a natural gas play. I've mentioned this before. Some of the names are trading at 1/7 or 1/5 the valuation as the blue chips. Like as a value investor, I'm going to take ARB opportunities like that all day long, even at $2.5, $3 gas. Here's Vermilion. You can see how everything went wrong, as I mentioned. Literally everything went wrong for this name. It was at about $30 US in late August. It proceeded to fall 50% in less than 6 months to about 14.26 US right now, and the option still made money. So again, I'm not trying to pat myself on the back or gloat. I'm trying to say options can be used effectively to fit a certain kind of portfolio, a certain kind of investment thesis. I never had Vermilion equity. I played it strictly through options, and if the cycle is such that you're buying things cheap, you're buying things early, and the cycle makes sense, everything could go wrong and you could still end up making money over a long enough investment period, which in this case was a year. I'm not talking a 5-10 year investment period. I'm talking, within a year to 2 years, sort of period at that point. So we'll move on a little bit to the stocks. And just before I get here, another reminder, if you do want to join for the Zoom visuals, whitetundra.ca, just scroll to the bottom under events, and the Zoom link is in there, and you can join in. I do apologize, I can't take any questions over Twitter Spaces, just given the recording of the Zoom and how it works, but happy to kind of chat on here. So Journey Energy, name I bought in October 2021, found it trading very, very cheaply relative to peers. I liked the power gen that was coming online, a little bit of the modeling around that. There was already a thesis that because of the coal units that were decommissioned in Alberta, that the power price was going to rise, especially as we head into this LNG Canada start, obviously a few years down the road. But really like this name. I had a kind of a hunch on the East Duvernay as well, which didn't pan out. But this name really benefited from momentum trading on small caps. I sold it on relative outperformance, made about 75% in 2.5 months. So pretty happy for it at the time. And just look at when I sold this. I sold this in early January of 2022. So at this point, I was already had allocated a bunch of money into options. I had allocated a bunch of money into kind of rejigging the portfolio. And I just didn't want more junior high torque exposure. Removed it, and it was at a time already trading at a significant sort of outperformance to its peers. So I took it out, reallocated, and just made some changes on the fly. And I think this is something that I learned as I went, is that some of these smaller names, they have like impressive runs that can happen in a very, very short period of time. And if there are opportunities for very similar companies that have not benefited from that, I will reallocate those accordingly. Now, of course, we've had less and less of these like huge runs happening in very, very short periods of time, but it's going to happen again. I can almost guarantee in 2023, there's going to be some names that out of nowhere pop up 60% in a month or 100% over a 3-month period. And it just makes sense. Like, look, there's nothing really that's changed here. Maybe it's time to kind of, sell this and go into something different. Still quite happy with how things panned out, despite the fact that Journey, as you see here, continued going up, and it went up another 35 to 40%. About 30% over the next, call it 6 weeks after that. But so did other names, right? So just because one name went up doesn't mean you didn't still end up doing well. So there's always a case that can be made to swap on huge spikes in certain equities. What's my rationale for MEG versus Athabasca? So simpler name. I don't like shale. I don't like the Duvernay, despite what Murphy is drilling some of the best wells there in that, I believe is the Two Creeks area. Very light oil, very useful oil. I just don't want to be involved in high decline Duvernay projects. And then I'm just not a fan of Athabasca management. Like I will be completely blunt with you. I don't want to put my money with them. I think there's money leaking out of the pockets there, where you leave your house with $1 and you end up at the bank with 75 cents because a nickel fell out here, somebody swiped a dime while you weren't paying attention, and then somebody took another dime, or you bought like chewing gum at the store with another 10 cents. And just a bizarre thing. I've been tracking this company for almost a decade at this point, as to their free cash flow versus what the expected free cash flow should have been. And there's always a divergence there. That being said, Athabasca trades about half the dollars per flowing barrel than MEG. So as a true value investor, hey, there's a very strong case that can be made to buy Athabasca. I just like MEG. It's a simpler company. They've got the same sort of tax pool coverage. The oil sands quality speaks for itself. And the buyback, I really like buybacks on my top position. When I have a large holding in a margin portfolio and they're buying back stock, actively supporting the share, that's what I want. I want my margin positions to not be fluctuating wildly up and down, creating headaches on a day-to-day, week-to-week portfolio allocation basis. So from that standpoint, you can argue dividends versus buybacks all you want, but for the most part, my bigger names, at least one of my 1A, 1B, 1C names is going to be one that has a very strong buyback support, because I just think it's required. It's the only way you can run a, call it 20 to 30 to 40% margin portfolio, is if your top positions are relatively stable. And Meg has by no means been stable, but it's still been a name that I continue to hold and have very strong confidence in these 40 to 60 year reserve sort of things as time goes on. So yeah, I'll talk about Obsidian here a bit later on. And as far as Journey goes, I'm not interested in Journey anymore. I think there's better names on a relative basis. And also I found other names with bigger power gen units already. So it gives me an opportunity to sort of take advantage of that still and keep my allocation to the smaller names about the same. Yeah, I'll talk about all these names here as I go on, including Meg, but I don't think the TMX is baked in by any means. So if it can come online in the end of 2023, should be a nice little boost. And at the same time, I think the buyback support is going to be really what drives the share prices here, especially if the heavy oil differential can sort of come down a bit, as it has been. Okay, so here was one that was kind of my foray into trading and trying to time the markets and trying to scalp money. It didn't work. So I bought Whitecap on March 8th of 2022, $10.15, and proceeded just 6 days later to get a margin call on it, down 8%, and I just sold it. This is one of the situations that is very difficult for investors to deal with when you just bought a position that you're highly convinced on, and the market has this blip, and now you got to sell something that's in the red. And a lot of people struggle with this. I notice I talk to people and they say, oh, I'm just waiting for it to come back to this amount and then I'll sell it. And it's like, well, I understand that sort of investment philosophy. It's a philosophy I ran for many years. It's a philosophy a lot of retail investors like to use. At the same time, just be cognizant of what you're doing there. You're putting yourself under a pressure that is unwarranted. You shouldn't expect to win every single trade. If you psychologically want to have never lost money on a trade, so be it. But I just think it's not going to result in long-term positive effects to your portfolio. If there is an opportunity to kind of sell something that you got into maybe on a whim, or can be quickly liquidated and then maybe possibly even re-entered, may make more sense than trying to screw up your entire portfolio in order to hang on to every position such that you don't have to sell anything at a loss. And this mostly applies to margin portfolios. So just keep that in mind while I'm making these comments. You can see what happened here. So March 8th, there's this momentum that carried Whitecap from $9 to about $10.25 in about a month. So February, or sorry, about, call it, early February to early March, there was this run up, somehow ended up buying at the top of this. The stock proceeded to fall about 8% in a matter of a week. And lo and behold, as what we always think is going to happen, the stock then went up from there, looks like about 10 to 15% in a matter of 2 weeks. So, in hindsight, you say, how stupid I was to sell this thing. It didn't make any sense at the time. But look, you're never going to be able to hang on to every stock. You're just going to end up trimming everything as you go, over diversifying yourself for no reason. And this is one that, is just one that in hindsight makes no sense to me. Like, I bought here, I sold here, could have been the dumbest thing ever, very small trade. And that's when I said, trading isn't for me. I'm just going to buy what I want to buy. I'm going to buy the options if I want more leverage, more equity, more torque, and then just just leave things be, as opposed to trying to scalp these pennies and cents, because it was tying up a lot of my capital, getting stuck in these names where I wasn't able to hang on for the real rise. And look, Whitecap, from the day I sold it, went up not just 15% in the next 2 weeks, it went up about maybe, let's see here, 20% or so in the next 4 to 6 weeks. So completely correct on the thesis. Everything played out exactly how I said. I just over-margined myself at the wrong time and got stuck. Happens. You live and learn. And this is why I just don't even care to scalp these little moves. Can they provide a good entry point for longer term positions? Yes. Can they provide a good entry point to add to positions? Yes. Can they provide a good sales point, a selling point on the highs? Yes. But as far as trying to scalp these moves, there's just way too much unexplained volatility within oil and gas on a day-to-day basis, on a week-to-week basis, on a month-to-month basis, that I'm just not confident in doing these things. But hey, a lot of people are, so that's what makes a market. Okay, so I don't run stop losses. I have never run a stop loss on any single position ever, nor have I run a I'm not sure what you call it, but where the stock goes up and then it sells itself at a certain point. I have never run that. I think if I'm going to be running a margin portfolio full of not full, but a margin portfolio also exposed to options and junior names, you should live a lifestyle where it doesn't matter what's going on in your life. You can take 5, 10, 15 minutes off and just focus and decide what you want to do. If you're working somewhere remote with no access to a cell service, you're working somewhere where you're in a high pressure environment, you're driving all the time, whatever, I'm not sure it makes sense to be running very, very torqued up margin portfolios, because the markets can move in a hurry. Like I will say this from experience, the markets will absolutely slap you, and then while you're on the ground, will kick you like without any care for your feelings or emotions. So especially in the oil sector, this is a lesson I've learned. When I used to work in the oil patch, when I was out there with no cell service, I was busy, really focused on what I'm doing at work, keeping these wells running, optimizing them. I just could not run these sorts of portfolios, which is why I think I figured that I never got into margin or options until October 2021, where I was really, had a different kind of lifestyle that allowed me the openness to go and spend time if I really needed to on these things. So yeah, I have looked at ARC Resources. Yeah, it was my biggest position. I will share a kind of information on that as I go on. Yeah, so the other question here is, would you generally buy on the downtrend versus the uptrend? I don't know. I don't know if there's any real conclusions that can be made off this so far. I just think that over buying options in equity, trying to maximize your margin position, I don't think is a good idea. So that's the way that I'll phrase that, is leaving a bit of room such that when you're really heavy on margin, you give yourself a bit of a safety net. Definitely helps for sure. Yeah, no, I don't run any butterfly schemes, straddles. I don't run any hedges. I don't run any of that thing. If somebody can give me a scenario and a portfolio allocation where hedging has actually made them money over the last couple of years, I would be very curious to see it, because what I've found is that people who actually benefit from the hedging and straddles and whatnot end up paying a whole bunch of premiums over the year that kind of takes away from the downside protection anyway that they're getting. And when there is a major shift in equities, they don't have enough exposure to protect them sufficiently anyway. So to that point, I think I don't think it's worthwhile, especially given the amount of time it ties up and the amount of thinking and constant reallocating that it takes up. But like I said, I'm very happy to be proven wrong. If somebody can show me some way that actually works. I'm not talking about putting in butterflies every single day. Like, I'm just not going to do that. I don't have the time or the care. But long-term strategies to put these in. If there is somebody who's been successful, then more than happy to kind of learn more. So another position, Cenovus, as I mentioned, Suncor was trading cheap in late 2021. Cenovus also was trading very cheap. And the one thing I really noticed was that the majors and the integrated companies were trading just as cheap as the small to mid caps. So you were getting the benefit of being in a bigger, more stable entity. You were also getting the benefit of the refining exposure, as well as just sheer, I guess, pricing power as the cycle went on. And I wasn't paying any more than a small to mid cap, so I piled in, and it ended up being a 42% gain in 4 months on a Cenovus, which is at this point a blue chip company, and really timed the early stages of returning cash to shareholders. So really did well on that. The dividend was coming out. They had a new debt pay down plan, which they constantly moved the goalpost, but it still helped the share price at the time. So pretty happy with what they did. But I just was losing confidence in management's ability to sort of understand what the market's looking for. They lost all that money on hedging early in 2022. They were having some refining incidents, and I don't think management was really prepared. I think for the Husky acquisition in a way, yeah. I mean, you can be quite well prepared, and the Husky asset was just so massive and large that there was gonna be problems to integrate that, given especially the age of some of the Husky assets and the overall maintenance required. So yeah, I guess pretty nice play, pretty happy with the way it panned out, and no longer one that I really look at this point in time. But at the time, you know, if I could buy blue chips for the same multiple as a small to mid cap, and I get their refining exposure for free, sounds like a pretty no-brainer. Where I am these days, not really looking at the blue chips, because they definitely trade at a premium for sure, like 100%. Not 100% premium, but I'm pretty confident that there's a premium being paid to be in these names, especially when you take into account the fact that almost none of them these days offer financial leverage. So you're artificially kind of impacting your portfolio returns by being in some of these names if the cycle continues to kind of rebound here into where it was projected to be. Saturn Oil warrants. So this was an interesting trade for me. I got into these Saturn Oil and gas warrants in February. I did a deep dive on this company, including talking to field staff and talking to people who used to run this asset before Saturn Oil bought it, like a very extensive deep dive. And ended up buying into these warrants at 4.5 cents. Pretty significant position, I guess, for the illiquidity of it. And I just sold them all. 2 months later, I saw issues with management. I saw issues with acreage quality. I was starting to get concerned a little bit about the overall business development plan, and sold it at par. I lost my commission. Fair game. Very happy with this. I think these are trading at 2 cents, sub 2 cents now. So, one of the things I learned is just don't be afraid to sell things when the thesis has changed. If there's an opportunity a month or 2 or 3 down the road where something changes significantly and it's an illiquid name and a big block of buy pops up, you'll just get rid of it. And again, this is not investment advice. This is me sharing what I have learned and what I think, my own opinion on this, my own interpretation on this. So especially in highly illiquid names, this can be a significant problem that if the price drops, now you don't have anybody to buy your thing to begin with, and you're in this spiral going to zero. There's also some rumors that were being spread around that Saturn was going to buy, make some major acquisitions, issue equity, and all this. And this is where, like, being in Calgary or being in tune with what's happening in the M&A market, even if the rumors, is quite important. And I think is why commodities is one of the only places in the stock market where you have a definite edge over possibly just about everybody else in the market. So when these rumors came about, I just said, look, these warrants are expiring in a year. If they issue more equity, there is possibly more dilution, and what's going to happen to these warrants, right? So sold them at that point. And one of the interesting things is that if you're confident enough and have a big enough bankroll, you can actually make the market on these warrants. So you can be a bid at 4 cents, you can be a seller at 5 cents, and effectively scalp that back and forth for years. And I have seen this done in other equities, in other warrants, and in other, I'll call it a unique junior oil names as well. So different kind of thing that I don't hear people talk about too much, but can be very highly profitable in a volatile junior cap company. And also opportunistic buying and selling. With these smaller kind of instruments, there will be sometimes huge blocks that show up that are looking for liquidity. And what I will do is I'll throw a bid in there 20% below, because as you can see, it's a 4.5 cent warrant. So even if you bid half cent below, you're already 10+% below the market. Throw in a massive bid at 20% below market and just leave it there, and see if the large seller is willing to sell into your bid, because they realize that there's no liquidity in these things for the size of transaction that they're trying to do. And I'll talk more about this because I was a little bit successful on doing this exact same thing that I'm describing, not in the warrants, but in other equities and other equities and junior names, which can provide you a little bit of income while you kind of keep a bit of cash position, which I think some people are doing these days, where they have this 20, 30, 40% cash position, effectively using that to buy large blocks when they show up, and then selling large blocks when the buyer shows up. Of course, there's risk associated with it, especially in junior names. You can get stuck in something, but I'm going to leave that up to you. Again, I'm just throwing out ideas to think about, stuff that I've thought about, and just some discussion topics possibly for the future as well. So yeah, I have never looked at buying calls on Brent or WTI. Yeah, have I kind of just peeked at them for curiosity? Yes, but almost no interest. Well, I'll tell you, I got no interest in buying them. I just think the edge is in the oil and gas equities for relative outperformance, even within the subsector, and then compared to the overall WTI and futures market either way. So here's Prairie Provident. I was the market maker on this stock for a little bit in call it late Q1, early Q2 of last year. So I would be flipping shares from 25.5 cents to 26.5 cents, sometimes intraday, and 4%. Hey, you make enough of these trades, and it makes it worth your while to be the market maker on some of these names when there's literally no interest on them. Obviously, illiquid name to begin with. These are the names that this is a lot more successful on, is your highly financially leveraged junior oil cap names. I would not recommend this or advocate this to anybody. I'm just sharing what I thought was interesting at the time and was able to make trades on, and scalp that 4, 5, 6% intraday, sometimes intra-week, and gave me a nice little use for that cash that I had building up, especially given that as equities ramped up into March, April, May, the margin room that they give you also ramped up. So there was a bigger safety net per se that I didn't want to allocate, but I want to use to my most effective sort of manner. And one of the things that makes Prairie Provident so interesting to me is that because their asset retirement obligations are so high compared to what the EV or the market cap or the debt is, this is effectively a company that cannot go bankrupt. The debt holder will not take this bankrupt, because if they do, the asset retirement obligations are the first lien debt over any other debt. So the debt holder is effectively screwing themselves, especially in this case, because the debt holder holds about 30% warrants on this name on the equity as well. So they would be completely shooting themselves in the foot with a massive shotgun, and something that I didn't see as a real risk. And until I was kind of talking to management. I was making sure that there was no restructuring happening. So you could have a bankruptcy risk not in the name, but you could have other sorts of instruments that could happen. So in April, I was keeping in touch with management, I believe at this time as well, and then throughout the year, and just making sure, hey, I'm not seeing the risk that is the biggest risk to me. It cannot go bankrupt. If I get stuck in this name for 2, 3, 4 weeks, a month or two, it's totally fine because I want to hold them anyway. And at the same time, it's a highly leveraged junior oil name, which is going to outperform in a bullish oil market either way. So, keep an eye out for these names that are out there withering away and kind of doing their thing. I can't speak too much about Prairie Provident as it is right now because I am under restriction, given that I have signed a confidentiality agreement, so have certain information that the rest of the market doesn't. And I'm not trading the stock either. At this point, it's on a cease trade. So I hope to share more here as time goes on that as well. So yeah, for sure. So when you're making the market on some of these names, be careful there's not a bigger fish on the other side that also wants to make the market. So, I wouldn't just jump right into this right off the bat. These are stocks that I've been tracking their sort of movement over a multi-week, multi-month basis to make sure there's no other large participants in this. This is one thing I learned with Athabasca. When I was buying Athabasca at 12, 11 cents, 13 cents throughout 2020, there was a large holder that was dumping 100 shares at a time, like every 5 seconds or every minute. And I was caught up against this flowing upstream kind of mentality, which still ended up really profitable. But I definitely knew there was a huge shark in the name. And there's no way that I would have been able to overrun the stock at the time, which was great because I was looking to accumulate. So for me, it kind of worked out at the time. Win-win. Yeah, I will be talking about Avila. Just hang on a sec. I don't want to jump back and forth when the equity itself is going to be coming up here anyway as we sort of goes on. And yeah, I'll talk about Surge as well for sure. So here's one that I discussed on my Twitter feed. Vital Energy made 34% on it in 10 days, and opportunistic buying and selling. There was a big block for sale for some reason. Somebody wanted liquidity. Oil markets were looking good in mid-April, piled into this thing. And lo and behold, 10 days later, there's a huge bid that shows up about 30% higher. So, very, very happy with this one. A lot of luck involved, of course, and timing. Momentum trades can move fast. So especially in these smaller juniors, momentum can really move them quick. And then there's a huge value discount in this name because it was a company people had very little information on. There's an inherent valuation discount that happened. At the same time, they drilled 3 very successful wells in the Frobisher formation that nobody was paying attention to. So yes, and I never wanted this to be a long-term position. Stocks where they have no corporate presentation, the management doesn't have a clear business plan. Half the management is sitting in China. We don't know what they're doing. There's a 60% shareholder. These sorts of situations, I don't want to buy them for the longer term, so I'll happily sell into strength. I sold half my position here. I sold the other half here, which was up 40%, sold in blocks. And one of the things I learned is don't get in your own way. When there's a bid on it, don't put your entire block for sale and kill that momentum that the stock had. Drip your way into that, and and you have this huge bid. Block on the bid that shows people that, hey, there's actually some pretty good support here, which who knows how these things work. It maybe activates the algorithms, it activates some retail investors who now want to have this FOMO effect. So a lot of things happening, but don't get in your own way by placing a huge block on the ask, and then it becomes like, oh, okay, well, there's this huge block, now we can just afford to wait kind of thing, and the share just drops from there. And it's relatively easy to play the bid-ask spread on these names because of iceberg trading. So, frequently when I'm looking at these names, I'll throw in huge orders in, well, it depends, small or big orders in at prices, call it between the bid ask. I will try and sell stuff and kind of just see if there's a taker for it in a very short period of time, or if it autofills because it was iceberg trading. So just because you see low liquidity in these names doesn't mean always that there's low liquidity. There's a lot of offers out there sitting, waiting to pounce for the right size block if it comes in. And that right size block may not be very big in some of these junior cap names. It could be, under $100,000, maybe under $50,000 in a lot of cases. But if you can make 40% on a $50,000, $100,000 investment in 2 weeks, yeah, it just depends on your own view on what your time is worth and how much DD you can do about these companies to get an edge on the market that other people don't have. Here's one on Whitecap. Despite my loss in March, I attempted to time it again and made about 2% in 3 weeks. Didn't really do much. There was a share overhang from their previous deals that was coming onto the market. Didn't really fully appreciate the impact that this has. When companies make multiple acquisitions, they've got these share blocks expiring in 4 months, 8 months, 12 months. You've got this churn in the market to begin with, if they did a bought deal or anything like that. So I just learned, hey, avoid some of these names when they get into this sort of pattern. Surge had the same pattern. Tamarack had the same pattern. Whitecap has had the same pattern. And, kind of, I say right now to avoid the name, but in April, I'll show you that there's a couple other other decisions that were made at the time, which in hindsight were not the right decision at all. So here's Suncor, 65% made on the equity itself. This was as I mentioned, a 30% margin position, which means I was getting 3.5 times leverage on my cash dollar for dollar. In 6 months, made 65% on the stock. You can do the calculation yourself on a 3.5 times equity leverage, what that ended up being. So, for all the people complaining about Suncor being this thing that was stuck and whatnot, I had a completely different experience. Didn't buy in when they first started their consolidation phase. I just waited and waited and waited, and sure, a little bit of luck, a little bit of timing, and ended up, performing really well. One of my top performers on a dollar for dollar unleveraged sort of basis. What I got, the return I got on every dollar put in was pretty fantastic over a 6-month time frame. So, yeah, I guess my no real major learnings here. I think just I guess don't be afraid to buy names that people have gone stuck in for many, many months. I mean, if they're stuck for many months in these names, that means the name has been consolidating for many months. And then if their peers have gone up in that time frame, it gives me even more reason to look at it closer, because there's obviously something happening short term. And if there's no reasoning for it, no fundamental reasoning for it, I'll buy it and just play the overall thesis as our time goes on. So value investing at its finest, I think. The impact of buybacks when they first start are maybe overstated, but the impacts of continued buybacks over a multi-year period are, I think, understated. So especially in a structurally bullish market. So just something to keep in mind. Just because buybacks have underperformed or dividends have outperformed, whatever, doesn't mean that's going to be the case going forward. So the thesis changes as time goes on. Different companies get different love. They get different people looking at them. They get different kind of funds flows. And just keep that in mind. I see this all the time where people have such strong fundamental conviction on a company, but because the trade market price has not fit that thesis, they just get bored and they exit. And that presents a really good, red flag that, hey, these people have been sitting in this name for so long with such strong fundamentals, and they're finally exiting, which means that, there's a potential buying opportunity here as there's a slight dip there. And then the stock is consolidated for so long that it has to ramp up now in a much shorter period than maybe what was the case 6, 9, 12 months ago. Also good for margin portfolio construction. I like names that are cheap when I'm 3xing the leverage, 3.5xing on margin. It has to be stable names that I'm buying for cheap. It cannot be a momentum trade, something I'm buying when it's already risen up, that kind of thing. And then the integrated value, obviously, if I'm getting refineries for free, if I'm getting $6 to $7 to $10 billion of gas stations for free, if I'm getting, I'm not sure what Suncor exactly owns, but some hundreds of megawatts of power gen capacity, cogen for free, these things all add up. They add up on the outside and drive the value as time goes on, right? So when you think about it, 10-15% of Suncor's market cap is in the gas stations, which are a very, call it, low margin business. So they don't really impact cash flow, but they're worth a lot as is. So when I started running calculations that way, it just made sense to enter this name at the time. Here's the chart for the 4 names over this holding period that I had. You see that Suncor was about 102% in that time frame. The dates are not exactly correct, which is why there's a little bit of a difference here that we're seeing as well. You can see the other names also performed really well, including Cenovus, actually, which was 132%. So really, really strong. But once again, I reiterate my point that I made earlier in this presentation. I'm not always looking for the biggest gain when I enter these heavily margined positions. I'm looking for the one that doesn't go down and still gives me a very, very comparable upside on the name. So it's just the way that I think is a better way to run the portfolio. But hey, everybody has their own sort of ways. Did I miss out on the biggest gain? Sure. But at the same time, if things went a different way, you don't want to be exposed on the downside on something that's 3.5x leveraged either. Here's another one that went a little bit different. I lost about 1% on this junior name. Didn't really realize how illiquid it was. This thing has basically no volume in it at all. Management is not active at all. There's no corporate plan. There's no corporate presentation. I thought I could make the market on this and just got stuck. I got stuck in the name, and it became an opportunity cost problem. I really wanted to use the money elsewhere. I was stuck for about 3 weeks and said, you know what, just sell it. As soon as a small, enough share block came in, I just dripped my entire position into that and got out, and never really even looked at it again. So there are names that this is going to happen in if you want to make the market. You're going to get stuck in some of these names. The idea really is try and find ones that you don't get stuck in to begin with. And if you do get stuck in them, keep your opportunity cost low. Don't get stuck in them for months and months and months with these positions that, even though they're doing really good stuff fundamentally, just have no liquidity, like literally zero liquidity to move the price. So pretty happy I got out of this. It's basically fluttered at this range for many, many months at this point. I did a presentation on this company as well, and there was literally, despite the strong fundamentals, there was no interest in buying it at all. So cut your fat quick. The extra positions that are eating up cash, if you want to keep them as like a cash proxy, sure, but otherwise these kinds of positions are just not good to get into. Buying something with a little bit more liquidity is a better, in my opinion, way of doing things. That, of course, changes if you think that the liquidity will come, that if you think there's some catalyst, there is the shares are going up, the market cap is becoming bigger and bigger, there's a new coverage by some analysts. Those may be reasons to maybe enter early and be patient as those catalysts come about. But in this name, there was none of those. You can even get a hold of management through email, let alone understand anything about the company more than their MD&A and financial statements. Tamarack Valley Options, same thing, completely illiquid. I eventually ended up buying, like $300 worth is all I got on the Canadian exchange. And that's when I said, you know what, if I'm going to be on the Canadian option side, it has to be like a Whitecap or some of the bigger names. I just cannot buy these Tamaracks and all this, Obsidian on the Canadian side. just because even though they have options, they're selling them like 5, 7, 10 contracts at a time. It doesn't make sense to get into these names through the Canadian option side, which is really unfortunate, because I think the Canadian names could really benefit from people understanding the macro, understanding the stories, if they were allowed to kind of trade more liquid options on the Canadian side. So Tamarack again had the acquisition and the shares overhang, and I've learned now that the US side has an all or none order on options, which I've been using, as opposed to the Canadian side, which I believe doesn't have those. So another disadvantage to being on the Canadian side of the options, on the smaller names, at least on the non-dual listed names for sure, and even on some of the dual list names, seeing this problem. And an unclear plan, right? In May, Tamarack had an unclear plan. Like, what are they doing? Are they doing more acquisitions? Are they doing dividend? Are they doing buyback, production growth? What exactly is their plan? I've now found out that this sort of messaging confuses investors, and there's this overhang anyway post acquisition. So hey, you know, where she goes, but in the future, avoiding names that are trying to do everything at the same time, like grow plus buybacks plus dividends, and all this. It really confuses investors as to what they can expect going forward, especially right after major acquisitions in the company. So Whitecap options, another one. So I was really loving Whitecap at the time. Liked the way that the stock traded, loved the upside on it. The acquisition was really good. Some of the acquisitions they've made in 2020, 2021 were really good. And then the 2022 acquisition happened as well. But really what I learned is I was getting overexposed to one name, like way too overexposed. I had equity, I had the options, multiple options throughout the summer and fall. I also realized that as we got into May, June, the overall portfolio dollar amount was getting bigger, and so therefore there was more and more movement happening in the overall portfolio, and I just wanted to reduce my options exposure. So exited at about a 20%, 15 to 20% gain on this, held it for about 2.5 months, and really started focusing on further out expiries. And this was January 7th, so this was a euphoria vibe. One thing to really focus on is any sustained moves up or down without like any really strong fundamental reason, like massive funds flow coming in. Be on alert, be on edge, try and sell a couple positions. I'm not saying, again, not investment advice, my own way of looking at things. I sold some of my option exposure. I will talk about some of the equity exposure that I pared down as well. And really with a euphoria vibe, right? Stay calm. There's no need to get caught up in these things. When this happens, everybody thinks they're a genius. It's a self-fulfilling prophecy. It's a snowball effect. I myself get caught up in it, feeling really good. And I'll tell you let me see, where am I here? Yeah. So I'll tell you the story that happened before I get to ARC Resources here, which I also, by the way, sold on June 8th on the exact top day of the market. So the story that happened is that my buddy was down here from Calgary, and then his other buddy was here down in California from San Francisco. We had a little trip into San Diego, and then I believe we drove to Vegas after that. Had a great time. It was Buddy's 30th birthday as well. And obviously you're in Vegas, so you're gonna have a great time, not really focusing on the markets per se. This was late May. Things were really wrapping up. And after that, we came back to LA. And I remember, I don't know what I was doing. I was talking about the markets with my buddy, and he goes, is your portfolio now at this dollar amount, right? He just mentioned a dollar amount that he thought my portfolio would be at. And I just said, no, it's actually more than twice that amount. And really gave me a pause. I said, well, like, what is happening here? This market has gotten a little bit even higher than I myself had thought about. So I really just like took a step back and I said, what is happening here? When I'm looking at it from a different person's lens, the ramp up that happened in May and early June is not really making any sense. Maybe it's time to trim a couple things. So I sold this option. I sold my largest position, ARC Resources at the time, about a 77% gain in less than 4 months. Again, a name that people are complaining about getting stuck in. It has done nothing but consolidate. It's not doing the right messaging. Well, you know, a little bit of luck, obviously, always in the markets, but 77% in 4 months on ARC Resources, right? Buy when it's consolidating, and then when something changes, you kind of get out of that. Luck, was it luck? Was it instinct because of my conversation with my buddy? Maybe a little bit of both. Sometimes things just work out that way. But there's a bigger issue here. I was just getting data at this time from Rystad that the Kakwa well productivity had dropped off pretty significantly since 2017. And I at this time had been really deep diving into shale, looking at the Permian, looking at Eagle Ford. I was kind of spooked at some of the stuff I was seeing from a shale company standpoint. I was feeling more bullish from an oil supply demand standpoint. And when I saw shale, the Montney isn't really a shale, but it behaves like a shale in terms of its well productivity and well declines. And when I saw that, I said, I know 7Gens had already very highly capitalized the Kakwa area, Kakwa Car, and I just did not want to be part of that. So at the time, it ended up that this got sold instead of Meg or Surge, which were kind of my 1A, 1B, 1C positions. ARC was also suffering from delays around the critical capex on the Atachi project. There is always this overconfidence at how fast things can get solved with the government or the First Nations, and how fast infrastructure gets built, right? We see this again now. We see, the TMX is going to be online for sure by Q4. Well, I've been in this trade long enough to know that by no means is that a guarantee of any sort. If it happens, it will give me a renewed confidence in the industry and what they're saying. But for the most part, people overestimated how fast this Blueberry River First Nation things was going to get solved. I heard in like late 2021 that it was imminent, and that same narrative continued forward until it finally happened. And at the end of the day, I don't think the deal that the company's got is all that spectacular anyway. Sure, it cleared up the headwinds to development, but there's some pretty significant ramifications that also happened through that process. So just overall things to keep in mind. Well productivity is something that I really focus on. It's my core thing that I look at when I look at some of these names. And then on top of that, I was losing confidence in management's ability to drive share price appreciation in this name with some of their messaging and my meetings with investor relations, a very conservative skew. I asked some of my contacts and they said, why are you, why are you surprised? ARC has always been this way. They've been conservative for 20 years. And that's when I realized, okay, I'm battling here against something that I don't have enough say into change. So I'll just invest in companies that more so fit my investment mandate rather than trying to move the world in all of these companies. Yeah, you can call me a genius, but a true genius would have sold all their names on June 8th. So it's just luck, skill, instinct, things you do along the years. You kind of figure out allocating portfolios, especially on margin now and on the options. And one thing really that I'm glad that I did is when I see something that I don't want to be part of this company going forward, and I'm already sitting on a big gain, I just sell the entire block. I don't sell 10% at a time or 25% at a time. That's reserved for companies where I still want to be a part of them going forward. On a name like ARC, where I had lost interest due to the reasons that I mentioned, I just sold the entire thing in one trade. And I guess I can share this. This was my first ever 7-figure trade that I've done. So you can imagine the euphoria along with the gain you're sitting on, along with the general broad markets looking where they were, and you're just having these visions and dreams all of a sudden. So to stay calm in that sort of environment is probably more important than staying calm when you have a 10-20% drawdown sort of week, because things can really get really out of hand in the way that you start treating money, in the way that you start kind of allocating capital, especially on a sustained high. So, things to think about as well. We are going to have more of these sort of euphoric moments. I don't doubt it at all. That's why I'm in this trade to begin with, and just have some, just think about these things a little bit more, right? When other people start to think like, oh, this is unrealistic things happening, right? People in the oil sector do it with other companies. They look at Tesla, they look at Microsoft, and they say, oh, this thing is trading in a euphoric fashion. But the people who are in the trade don't realize that. So sometimes it's good to talk to people who are outside the oil trade, people who are not in investments to begin with, and just see what they're saying, right? Like, what are they thinking here? And sometimes your gut feeling, right? Like the whole gut feeling thing. Hey, anyways, I don't want to go on too much more about this. Tamarack Valley, I sold half of my position in June. This is a name that I bought in April, late April, I believe. And what happened? So I ended up getting a bit too aggressive with my positioning, where I had too many positions that were highly concentrated. So instead of having 1 or 2 big positions, I ended up having 5 positions that were, call it a 10 to 12% range at the time, if I'm not mistaken. So too many large positions. I had to trim a couple of them. And so I just basically sold half as is. There was also the Tamarack acquisition overhang that I've mentioned earlier. Buying early in these names gives you a lot of flexibility. And I'll share more about this on the next slide. Also using positions in the green to add margin. So when somebody gets access to this big capital pool, I don't think it's prudent to go and add the entire thing on margin and just buy stuff. But if you have legacy positions that are 50, 60, 80, 100, 200% in the green, and you're adding margin on that, it just makes things a little bit easier to sell. Like if the market drops 10%, 20%, you still have a plethora of positions in the green that can be sold without the psychological impact, and just, you move on, you kind of look at things then from then onwards. And stay calm, stay very, very calm. I cannot stress this enough. Panic is going to do you no good. It screws up the way you think. It screws up the way you allocate probabilities, statistics, how you think about the risk reward scenarios. Overemphasis on the signal or overemphasis on the noise in the market can happen. Stay calm. You're in the oil trade, it's going to be volatile. It's going to be ups and downs. Very, very important. And I think for those who actively trade, it's even more important to have your me time, have your walks, have your gym sessions where you can kind of think, put out a bit of stress, as well as kind of just like overall keeping yourself in a proper mental health state and planning ahead. So what I do in a lot of cases, like right now, even for example, I have scenarios. Okay, if my equity goes down this much, okay, or let me put it a different way. If I have to pull money out for a private placement, what am I going to sell? And is there enough liquidity to sell it within that short time period or long time period that I'm trying to sell it on? So having action plans in place for the future where, okay, if the market goes up 10%, if the market goes down 10%, if a XYZ company acquires this or whatever, what am I going to do is a way better way of doing things than to just say, when the situation happens, then I'm going to deal with it. On the macro side, in a way, you can work with that. But on a portfolio allocation standpoint, there's definitely needs to be a plan of some sort where you have specific names that you want to exit, specific names that you want to maybe add to, specific names that get the red SOS button that, hey, if things really hit the fan, I have this name that has really good liquidity that I can sell entirely and kind of get back on my feet after being punched in the face, right? So very important, very important. I cannot stress this enough. The amount of people I see just willy-nilly entering trades without any understanding of their portfolio construction or what they're doing, and then shirking responsibility on other people, not just in oil, but just across the markets, is really, to me, not a good sign. It's not a good sign. It's frankly not how the market should run. Right now, it is running pretty effectively in that fashion, but at the same time, this is not a get rich quick scheme. This is not a lottery ticket. This is not me betting on red or black. There's other ways, various other ways to play those odds in a very short time frame. These are actual businesses that you're buying, and businesses have pitfalls. Businesses have pros. Businesses have hidden diamond, valuations that come out of nowhere. So lots of things to keep in mind besides just kind of buying and selling over and over and over. Here's Tamarack when I talk about buying early. So Tamarack was bought late April, as I mentioned, somewhere here. You can see how I was able to sustain a 10% drawdown. And from the drawdown, Tamarack went up 40% in a month, able to really take advantage of that. And then from the top, it fell down like 35% in the next month. And I was able to exit half my position at break even, right? If I'm buying into the momentum as the market's ramping up, that's when you end up as the what they call a beg holder guy, where then you're complaining about the stock on Twitter for the next 6 months, right? So buying early gives you that flexibility to have this up run and then down run and still be alive at the end of the day. Yeah, for sure. Like it's easy for now to say, oh, you're just talking about positions that you entered in 2021. Well, next year people are going to say, oh, you're just talking about positions that were entered in 2022, right? Like everything moves in unison. Any trades that I entered in late 2022, the data is not out yet as to how successful they were. So I do appreciate kind of the point you're trying to make, but oil price is still $73 a barrel today. So it's not like we've ramped up substantially and then the position's risk reward has changed substantially as well. So yeah, I'll get to all these questions in the Q&A session. Some are a bit off topic, some are on topic, but will be discussed when the equity comes up. And yeah, as usual, we're way further into the time than I would have expected. So we'll just keep it going here. Yes, I do maintain my half position in TVE still. I like the tax pool coverage. I like the water floods on the Clearwater. Very, very important thing to focus on. The Clearwater water floods with a tuning fork design are looking really good, like 400 or 500 barrel per day wells. So geologically, pretty happy. They still have the Charlie Lake, which possibly can be sold off for a pretty massive premium if they choose to down the road. And yeah, I think I got in a pretty good entry point where I'm getting a 60,000-70,000 BOE per day producer for 2.5 billion, 2.7 billion-ish, which I'll take that valuation on a emerging Clearwater, call it Aquarco sort of model that's now pretty much fulfilled. Spartan Delta wrote a Seeking Alpha article on this early in the year, and actually ended up not being able to partake the full benefit of that. I sold it up 29% in about 4.5 months. As we know, this went another 50% up from this level from July onwards till the end of the year. So kind of over analysis paralysis here. I had some rumors come out that Spartan was looking to merge or acquire some other Montney acreage, which obviously the market was not liking at this time. We saw the market's reaction to the Whitecap XTO acquisition around this time. I had seen Tamarack get stuck in this consolidation phase, and I just did not want to be part of that. And it ended up that nothing happened, no deals happened. I shifted into Crew, which still made me, decent kind of chunk of change, but not what Spartan could have gotten for sure. And just ignored some of the things that Spartan had. They were extremely undervalued still. They were doing a marketing efforts that I'd learned. They were attending lots of conferences in the US, doing one-on-one meetings. They had a pretty low float to begin with, a pretty tight float. There was rapid debt pay down, there was production growth, and the fact that in the Montney, bigger is better. So once again, over-analysis paralysis, and still very happy with being in crew. Obviously, no concerns at all, but definitely one where, missed out on the top performing name in 2022, one that I wrote a Seeking Alpha article on, one that I knew a lot about, one that I had constant contact with management with, and just sold on an unsubstantiated rumor that I let myself kind of get too far into. And hey, still up 29% in 4.5 months. We'll take it. Another Whitecap options. So I sold the June ones on the euphoria. The July ones, worthless. They expired at 0. Chasing the same stock. Another indication of 100% loss of capital. Really trying to fix these things up as I go on. And what I've learned is that with options, downside protection is really not important, because if your option is down 50%, your thesis actually strengthens on the option from that point onwards. Just given that you were willing to pay twice as much for it, obviously depending on the time premium as well. So it becomes very difficult to sell these things when they're down. So you might as well play options as kind of like a zero or hero method, which means maybe a little bit outside the money, and possibly maybe you buy yourself more time as a way as your downside risk mitigation, rather than doing it with the premium itself. We do it with buying longer dated options out. So just something I found. I no longer use the strategy where I'm worried about, okay, if the price goes down to this, can I actually get out of the option? Because it rarely happens or works that way, is my understanding. And I've got the experience to kind of show that to you. I also lost the Whitecap August option at a complete loss. Obviously chasing the same stock yet again. The financial impact of this is obviously severe. At this point, the Whitecap options were, call it, roughly 2 to 3% of my overall portfolio, maybe a little bit lower. But there's also a mental health impact to this. Kind of it really puts you off your game. You kind of have the self-doubt creep in. You say, what was I thinking buying these short-term options? And you just waste a lot of time regretting things and just overthinking. So really trying to avoid these things going forward. Any options I buy are now very long dated. I give myself at least 6 months, and at the same time kind of try and also buy them on names that are more beaten up, as opposed to trying to chase a thesis that I had with Whitecap at the time, that the funds flow on the carbon focused oil and gas investing was going to come into Whitecap, and that thesis has not played out at all. Neither has my thesis that the early results of the Montney wells are going to result in significant share price appreciation. Now, these two things can still happen, but I'm just tired of playing this thesis. That being said, I will share here shortly, I do have summer 2023 Whitecap options as well. So certainly one that I haven't given up on by any means. ARC resource options, bought them early, made about 190% on these, along with the equity as well. As I shared earlier, a lot of my options are bought on the equity itself that I own. And I'm not talking about selling calls, I'm talking about buying calls. And it made it much easier to sell the ARC Resources equity, because I knew I had this option as well that had a outside chance at 10xing at the time, given its expiry period as well. So yeah, trading options like equity, working around portfolio construction, and the entry point allows for a high floor, high ceiling bet, if you can kind of get in at the right time. I believe I bought in crew when I shifted around 575, 550, so not cheap by any means, compared to how cheap Spartan Delta was and the relative performance between those two names in the meantime. But hey, hindsight's 2020 always. Yeah, I'm not really looking at Spartan Delta right now, just given the messaging they put out around being bought. So once again, at this point where things are, now I like Crew better because Crew is down 10-15% from my buying point, where Spartan Delta is up about 40% from my sell point, 30-40%. You see how relatively things change, and you got to look at things as is. Another white cap option, September, expired worthless. Trust me, this is not good. Not long dated enough, buying these 6 month out options and buying too many of them. July, August, September, and June as well. Just way too much exposure to the same name, and kind of learning that as I go now is not recommended thing to do, even though the thesis may be quite strong at the time. So Meg, I sold a bit of Meg in October, 22% up, trimmed it to enter junior names. I was reallocating my portfolio such that the percentage of Meg didn't go down, but the overall dollar allocation went down, just given that there's a couple new kind of bigger names coming in, as well as more focus on some of the junior names as the year progressed. Keep them in the green. If you're running a margin portfolio, try and have your 1A, 1B, 1C in the green all the time, so you have flexibility to trim and add and use it to reduce margin when required. Don't try to hit high watermarks. Just because something was at $24 earlier doesn't mean it has to get there for you to, even consider selling a position should things hit the fan. So this was one that was really worked out well for me. It gave me the confidence to really add on margin when I needed to, accelerate that early 2022 performance. And then it was this stable machine sitting in there, holding me. It's probably going to stay there for quite a while yet. Very high torque, obviously, within a name like Meg. I did cover Vermilion earlier, yes, and yes, it will be on the recording there, Rez. Yeah, so if Spartan Delta does get bought out, it would be at a premium, yes, but at this point, the relative valuation for Crew versus Spartan Delta just made more sense to buy Crew, and I just don't want to be involved in these buyout kind of issues going on right now, because you're seeing what's happening with Pipestone. That is a name that is going to get bought out probably sooner than later, and yet the share price is just getting smashed. So not always is the buyer on your side. So just because it's going to get bought at a premium, there's ways in the Canadian oil and gas market where the buyer can actively dump shares, put a lid on the stock, keep it restricted while they pile on and buy more shares. There's a lot of funky things that can happen when you get these names that are actively for sale, and there's sort of this unknown issues that happen around that. Rock Resources, 73% in 5 months. I bought this in roughly in June, I believe. So at the high, it still gave me a really good gain. 51 cents was the first batch sale. That was half. I sold the other half, I think, about a month later. And hey, it gave me the protected downside with the really good hedges during a highly volatile period. I don't like the fact that the hedges are lower priced in the future. That's the way these hedges work in a backwardated market. And I sold it in tranches, and reallocated as required. This name was really highly outperforming its peers on relatively low signal, and I just saw other opportunities to move it in there. And keep in mind, these names that are under $3 with TD anyway can't be margined. So when I take $1 out of Rock, it effectively gives me $2 that I'm taking out when comparing it to a larger kind of small to mid cap or larger name. It's still a great management team, great assets. The hedging is still something that some investors are looking for. I myself am not interested in being part of an acquire-co of this size. So we know they're going to acquire more. We know they want to get into bigger scale. And if I want that kind of company anyway, why not do it within something like a Surge, which is just a lot bigger and has assets that I know a lot better and lower decline assets, right? So that's what it comes down to. And then Surge, I can buy 50% on margin, right? So and not just that name, right? You have to compare this against everything else within the subsector, which is the junior names, and then within the overall sector, and see what makes sense. And at this point, it just wasn't making sense to me at this time. So I sold a second tranche of Meg actually when I pulled some money out for some reallocation into juniors and collecting cash for an impending private placement that was announced here recently, last couple of weeks ago. Sold another batch of Meg, this time up 37%. Again, really solid return for 7-month period. And as the portfolio is getting larger, I think it's going to get less concentrated to begin with. It's just the way things roll. That being said, I'm doing my best to not become like that guy with 20, 30, 40 names in the portfolio either. So I'm really trying to remove names that are highly correlated to each other, that don't offer me any specific upside catalyst. And and part of that is just that some of the bigger names are getting trimmed as time goes on. Still remains, I think, a 16% position, so quite high for any sort of traditional portfolio allocation metric. And keep an eye out for range-bound activity. Meg has been range-bound for quite a while now, and moves pretty quick. So when the opportunity came, I mean, I really found this one as a good one to take some off the table. At the time, it's still my largest position, so it kind of goes to show you the confidence I have in this name, but also goes to show you a refreshed portfolio allocation strategy from mid-October 2022 onwards, as I saw some things happening behind the scenes, including the rig count dropping, which I thought was a first indicator that supply response has been permanently damaged with some of the political interference actions that were taken in 2022. Really good sign. It's continued on. Rigs continue dropping. The number of counties with the rig continues dropping. The frac fleets was down 8 last week. So these things don't really matter today. They matter over a compounded period of time. If you have 5, 7, 20 frac fleets out the market, outside of the market not working for a 6-month period, for a 12-month period, it really starts to show up in production in a basin like shale, especially in the Permian. So early indications I'm getting right now is like, okay, these things don't matter right now, but if we look a month or 2 or 3 ahead, you're going to have Chinese reopening, Southeast Asian reopening, along with the overall Fed sort of maybe pausing their pressure on the markets at the same time that U.S. consumption should go up, and then at the same time that some of these rigs in the U.S. have not really caught up. They're still dropping, and the supply response then gets really felt at that point in time. So just keep an eye out for these second and third order impacts that happen. Just looking at WTI price and making broad-based conclusions I'm going to tell you, is completely wrong and inaccurate. So really got to look a bit deeper into it, rather than just looking at WTI price and both victory lap in both ways, bullish or bearish. And then the higher interest rate on margin meant that my portfolio allocation strategy to juniors made sense anyway, given I was paying a lot of money on margin at this point, and I still am really, but I've lowered my number just by reallocating into the non-marginable positions. Inherently reduces your negative margin balance that you have going on. An average cost of 15, right? A very nice point where I think there's really solid support. I find it hard to think it's going to stay below that for any meaningful period of time, especially now with their debt payback where it is. They're reducing the share count about 1% a month. So it all goes into the share price as time goes on. It's not a science, it's more an art in that sort of standpoint. Crew energy. So here I reduced this from my I had 1A, 1B, 1C being Surge, Meg, Crew, all about 13 to 14% weightings. I reduced my crew energy in half when I got into the private placement the aforementioned private placement. Had to pull some money out. So ended up running with a kind of a 2A, 2B, 2C now between Crew, Obsidian, and Tamarack. And yeah, got a really nice sale price, at least on this, about 45 cents above what I bought it for, which means the rest of my holding is now at an ACB adjusted cost base of kind of $5.25 a share, which I'm pretty comfortable with that on Crew. This is the first name I ever wrote a Seeking Alpha article on in May, I believe, of 2020, and it's up about 15x from then, but I'm still a buyer. So that's what makes these cycles interesting. That's what makes the COVID portion of the cycle even more interesting. It gave people a chance, as I mentioned earlier, to build that capital by the time the cycle now is really beginning. Yeah, thinking about it from that perspective. And as I said, trimmed due to portfolio construction adjustment. It's my only exposure to the Montney. I don't need other exposures. There is no reason in my mind to be diversified in the Montney. And I know I'm going to have maybe some pushback on this, but Crew has the best acreage, the most undeveloped acreage. They have exposure to oil and gas and like sort of the mixed condensate rich wells. They have the best board of directors within their peer group. They have the best kind of acreage outside the Blueberry River First Nation. They have a lot of reserves value that is not yet being put into the value to begin with, and they still trade very cheap on a 1P basis. Their production is growing at one of the fastest rates in their peer group, and they have the acreage to back it up. So why should I go into any sort of different name, right? On an overall basis, it really destroys its competition at this point. Spartan Delta, yes, a great name, still trading relatively cheap, but once again, the outperformance over the last 6 months in Spartan Delta versus their peers is very noticeable, very, very noticeable, especially when you see how far Kelt, Crew, and Pipestone have fallen, which makes them relatively just better picks at this point, despite Spartan Delta's really, really good positives and well productivity that is really, really good. Quite impressive there. And the well results. When you have growth companies that you're investing in, the well results are incredibly important. They are the difference between your company hitting their production growth target or not. So definitely, I would suggest anybody who is looking at growth companies like Crew, like Obsidian, like some of the other growth names that are smaller, track the well results. It's worth your time. You can figure out when companies are going to miss guidance earlier. You also can figure out when companies are going to beat guidance earlier. You also get catalysts from the wells appearing on the top well results lists. So, people do track those lists and take them into consideration, especially when there's outperformance month after month after month. The RBC one obviously is one of the top ones. Jeremy McRae at Raymond James puts out another one that's a top wells list with some really good graphs as well. So highly suggest people looking into that. Yeah, so the current natural gas price environment is obviously impacting Crew and almost all Montney/shale stocks. That being said, I don't really care right now because this is a much longer term thesis. The share price has an inbuilt support now in this, call it like 425 to 450 range. And I still want Montney exposure for the M&A activity, for the overall thesis that the US names might be coming back here, as well as Petronas got a lot of land taken away from them in this BRFN decision and may need to acquire in Crew's area, in the Ground Birch area where Crew, Shell, and ARC are, and Strathcona for that matter. So it can stay there. Limited downside, quite a lot of upside. The reserves value in a really, call it, good environment, $100 oil, $6 gas environment, 3 years down the road, the reserves value is going to be north of $50 a share, even in something like Crew. So the undeveloped land is really the big cherry on top of the cake, as well as more valuation and importance being given to owned infrastructure and pipelines. Paramount just sold roads for $50 million a few months ago. So all these gas plants that Crew has and the other companies have and then the pipelines, the land, the roads, the infrastructure, it all has an inbuilt book value that is going to get reflected as time goes on, especially in an environment where both supply chain and inflation make it really hard to build new infrastructure. So the existing infrastructure's value continues to go up as time goes on here. Here's my sort of overall what I did with interest and dividends. So you see my interest costs rising pretty rapidly from January to June. At the same time, my margin balance was not rising at the same rate. It was still going up, yes, but not at the same rate. So, kind of was using margin very effectively. And then June, July, I started to get a bit concerned just because the overall margin dollar amount was bigger and the interest rates were now coming in. So as you can see, since May, actually, I've been trimming my margin balance the entire way down. And I think this is true for a lot of people. I shared the FINRA chart earlier, which kind of verified this as well. And really something to keep in mind. If you're running a heavily margin portfolio, that now the dollar amounts are getting bigger as the shares go up, you're now more in margin and at a higher interest rate, just keep this in mind. This is something that can catch you off guard. And you could be somehow high 5 figures, low 6 figures in just margin interest in a year, possibly even more than that for people who have bigger portfolios. So, as you can see, my trend, I started cutting down on the margin balance. That being said, even though my margin balance is down more than, looks like about 70% since May, my interest has actually stayed only down about 20%. So this is the impact of rising interest rates on not just oil and gas investors, but in the general kind of stock market to begin with. And then in the oil sector, more so because it's so volatile and illiquid in some sense. I also put my dividends in here. So early on in the year, I was trying to match my dividends to my interest cost and the margin, and really did a pretty good job of doing that for quite a while. And even for the rest of the year here, I do think it helps. Not that I really focus on it, but it does help take out some of the brunt of this monthly interest payment when you're running a margin portfolio. So I'm not against companies paying 2-3% dividends right now, because it does help my overall kind of not having to watch these things all that much closely. And then you got a few names in there with maybe a little bit of higher dividend. I personally, now that I think about it, I don't have any names that are more than maybe 2 to 3%. So our dividend, Meg is completely buybacks, and the rest are, some of them don't even have dividends or buybacks, like a Crew and an Obsidian. So different ways of looking at things. Doesn't bother me that much. If I can use margin even at 7, 8, 10% to make more, I will. But you got to be very careful around this. Don't get overconfident. Don't have hubris on your own investing capabilities and how the market can absolutely, like I said, slap you and then kick you while you're down. So many brilliant high IQ individuals, the market has, not even worried or got bothered by them, because these individuals got overconfident. They started running very complex strategies, and the market said, "Oh, welcome. You must not have seen the past 100 years of history, where the stock market is effectively a survivor bias, a kind of initiative that you're taking on." So many high IQ, brilliant people with fundamental, strong theses, with thousands and thousands of hours of work, have not just been humbled by the market, but have really suffered long-term mental health consequences of doing that sort of activity. So yeah, just be careful is all I can say. Watch things closely when you're on a margin. The Westcan private placement, this was another name that didn't get shown in my portfolio because I never put the shares in my brokerage until like 2 or 3 months ago. Bought these at 10 cents. As people know, it ran up to about 48 cents in June. It's now back in the 10 to 11 cent mark. And many learnings that I myself have shared, that other participants have shared, Sohaib had a space on this last week, I believe. But really, what I find fascinating here, and I've discussed the other things much more in detail, so I'm going to leave it out for the sake of this presentation. But here's what I can come down to is a lot of things went wrong with this name. The thesis didn't pan out exactly as we thought it would. There was lots of significant issues, both fundamentally and governance kind of ways. And we're still up 10% on the private placement, right? So by buying cheap, by buying early, by identifying both small, mid, large caps and junior companies early, you give yourself that safety net, especially in this cycle, because junior companies are being bought at 2, sometimes 1 to 3 times cash flow, as opposed to previous oil and gas cycles where people were entering junior companies at $100,000 a flowing barrel at 6, 8, 10, 12 times cash flow. You can see how the risk reward on these things just doesn't make sense. When you get into buying companies at 8 times cash flow, it's a growth company, sure, it's a $100 price environment, okay, but you're still buying so high that the risk reward may not be worth it. When I get to buy these names at 1 times cash flow, man, like the entire world could like go against me. Everything could fail, and I could still end up with a very slight loss or even a very slight gain, just because the company did make money during the $95 environment in 2022 that we had on average. So there's a natural kind of cash generation that happened during that time. Okay, so I think I got a few more slides on names that I now currently own. So we'll go through these and then do a quick Q&A and then call it a day here. So a quick reminder for anybody on the Twitter space, if you do want to join us for this last part of the Zoom visuals, whitetundra.ca. The website is also in my bio, and you can join us for the Zoom link. If you scroll to the bottom under events, the Zoom link is in there. So my recent purchases, how I'm allocated going forward. Obsidian, July 2023, US $7.50 options. Bought them about a month ago now. Paid a 32% premium, not what I want to pay. Obviously, it shows down 50%, but that's just because the market isn't updated over the weekends. TD's dashboard is kind of weird that way. Down about 20 to 30% right now on this. And what do I see? Why did I enter this? The 52-week high for Obsidian on the US side, if it can just get to that by July of 2023, I will end up with a 450% gain. Okay, so now the risk reward already makes up for it. I've already mentioned I don't worry anymore about downside protection on options. I'm looking at it as, okay, I need to buy myself enough time, and the upside on it needs to be worth it to make sense. In the meantime, since Obsidian last hit its 52-week high, it's paid off about a share, $1 per share in debt. So effectively, if we want to get back to the same enterprise value, the share price actually should be $1 higher, since the debt is $1 lower per share. So my gain would actually end up being like almost a 600% gain if it just got back to 52-week high. A lot of names, if you really look at them in the Canadian oil and gas space, are very close to 52-week highs already, 10, 20% below it, and probably expected to go much higher as the summer goes on. I've given myself till July. I didn't want to do the April ones. It's just too early. July lets me do the full summer driving season and the full jet fuel season, which I think is a major factor this year in terms of overall global demand. I also like July because, as I mentioned earlier, the real impact of $75 to $80 oil trading range on US supply is going to be more and more obvious kind of 3 to 6 months down the road from where we are right now. So pretty happy with this. Gonna kind of leave it here, see what it does. There's a possibility for the first time ever, I might actually roll this option. If it ends up slightly, to a little bit in the green, I might just roll it to kind of a January 24 or something. We'll see. But overall, I like the thesis here. This name has been really beat down for very slightly fundamental reasons that can be fixed up. And yeah, I just don't think it deserves this sort of discount. And the option premiums were looking, semi-decent. I don't think I got a deal by any means, but willing to take a shot here. Again, I already own Obsidian equity, so it gives me that other torque where if I do want now, I can trim some of my Obsidian equity and use that money elsewhere if required. Here's the chart. You can kind of see how it's so volatile. I mean, up and down, and then it's up another 3% after hours, really up there. You can see the 52-week high here on the US side. This is the number that I'm running my modeling on, 1252 per share. Again, adjusted for debt, the 52-week high is now about $13.50 a share, more than double. We have yet to go. So the names that get beaten up, the names that people hate, once they consolidate in a little pattern, I'm always interested. I also bought China Southern June 2023 US $1.35 options. China Southern Airlines pre-COVID was on pace or on track to be the world's biggest airline. Right now, they're about 50% as big as American Airlines, which is right now the world's biggest airlines in terms of flights per day. They also have this is the way to play the Chinese reopening. They have hubs in Guangzhou and Beijing. Guangzhou being China's third biggest city now, very, very rapidly increasing. So having a hub there is quite important, as well as Beijing, which just opened its second international airport. The Beijing Dazing Airport is now also doing international flights. So I like having those hubs, big economic kind of indicators, lots of business, lots of industrial manufacturing activity, as well as they might be joining the One World Alliance. This is one of the only airlines in the world that is not in one of the three alliances, the One World, the Star Alliance, and then the Global something, I think it is. So a catalyst on the horizon. It's been in the works for a couple of years now. Also in the One World Alliance are Qatar Airways and American Airlines, which both own 5% in China Southern. So there's a natural benefit to allowing them in to their, call it conglomerate. Aims to be the world's biggest airline, and it's literally a bet on international flight rebound. I think the Chinese international flight rebound is being counted out. I'm going to give them 4 to 6 months, so not anything sudden, but give them enough time to let this play out and just see those margins increase. The state, I think, owns 60% of this company as well, so very strong support there. And hey, I have no issue playing Chinese equities. Please keep in mind, for anybody listening here, this was delisted from the New York Stock Exchange, so the options are now trading over the counter. The equity is trading over the counter. You can no longer buy the options. The thing with Chinese kind of stocks and whatnot is that people are just too negatively skewed. It's the same in the oil market. It's the same against many, many things that I see, is like everything has this guilty until proven innocent thing, and it drives discounts that I see. I'll happily arbitrage those discounts when they're not fundamentally chosen. So can this thing still go wrong in something that I don't see? Yeah, possibly. But an airline that's increasing its flights by could be up to 50% here more in the next 3 to 6 months, maybe 100% more. Also an airline that kept all its staff and pilots from pre-COVID. So they're not suffering from the issues that some of the other European and North American airlines are suffering from, as well as the international flights are really your big money flights, business class, first class, premium economy. These flights are ramping up at a time when the US flights, the US airlines have been gun shy. They have been gun shy from launching routes back into China and Asia. So there's a natural void in the market for some of these Chinese airlines to come in, which they are. They've taken up a lot of market share going into Australia, New Zealand, Europe, and even the US to China kind of indirect activity. And they will continue to take market share as time goes on. Yeah. I mean, oil prices are not high right now. So oil is at $73 a barrel. I would not be worried about demand destruction at this point, as well as if we got to $80, $90, $100 a barrel. Keep in mind, China has ample refining capacity where they're making a ton of margin on those barrels. So Chinese jet fuel, Chinese airlines are going to consume that jet fuel as opposed to American jet fuel, where we have a refining problem and an inventory problem currently happening at the moment in front of our eyes. 88 Energy, this was an Alaska play that was bought earlier, about 2 months ago now, 2.5 months ago. Bought it on a very deep dive into Alaskan oil and looked into the Pantheon drill, what was happening there, and the secondary impacts of that on other names in the area. If we hit just a 52-week high on this name, I would have a 535% gain. Excellent. There's catalysts on this name. There's catalysts around names that this name closely tracks. Really big fan of that. There's also some money coming into the exploration cycle. I don't like names like Recon Africa and some of the other names that got pumped up to massive valuations for no reason, really, before they had any clear results. But people are willing to chase these things. And if I can get into them very early after a capitulation event and just sit on them with really, really good geology, really good upside, and a neighboring company spending the money instead of this own company spending all its cash lineating, good, I like it. What I call it is a capitulation, then consolidation environment. So currently up about 43% on this name, 2.5 months. They just announced a raise that people were worried about was going to be at a very low price. And the raise ended up being only 10% below market. So the stock really rebounded swiftly. And the raise was still at about 25% above my entry point. I'll take that any day long, all day long. If I can invest and then big investors are willing to put in their dollars at 25% above that, hey, be my guest. Welcome to the show. Here's the stock charts. This is about where I entered right here, late November. You can see why I entered this name. Here's your capitulation phase. Here's your consolidation phase. And it was almost a year-long consolidation that this stock went through before I looked at entering it. I've been tracking some Alaska plays way earlier in the year, last year, but never really found them serious enough until I saw actual well results from the Alkaid 2 drill come out and some of the earlier indications that management had put out. Not 88, this is Pantheon I'm talking about. And you can see how the risk reward on this name versus this name has panned out really well. I don't like these hundreds of millions of dollar companies trading on exploration potential. I understand that they may have bigger acreages that they have more reserves and all this, but the downside risk is just much higher, as you see here. I also like companies that got completely trashed, but yet their geology is still really good. You may have seen this in my investing strategy in other companies as well, where if the rock is good, if the geology is good, and the company is down substantially, as in the case of 88, it was down about 80% in March 2022. Yeah, I'll buy in. I'll wait for the cycle to play out and have my very low entry point and just leave it there, let things play out over time. Yeah, so what makes these two companies? I don't want to get into this becoming an Alaska discussion because there is a specific discussion planned on that. But there are no licensing issues in these two names because they are right on the Dalton Highway. They are right on the TAPS Trans-Alaska Pipeline System. And they're also able to build gravel pads instead of ice pads, which really saves a lot of cost compared to kind of going further away from these two, call it infrastructure points. Yeah, so there's multiple reservoirs in this area, so everything is really a one well shot at this point. But as things go on, it develops over time. This is by no means a 3-month play for me. This could end up being one of my multi-year plays, assuming things look constructive still as indications come out. I've said this before, some of these higher cost acreages become very economic when oil prices do rise and they can be properly capitalized. Quick comment on Surge. Bought it very, very early. it did a really good job protecting my margin portfolio. Average cost base $5.68 a share, 62% up right now. Decent enough volume that I could exit the name if I needed to in a things hit the fan scenario. It has anchored my portfolio for many months now. I first got into this in the summer of 2021, so kind of quite a while. I've also held Surge shares since 2014, earlier legacy position in my TFSA. So that is now sold, I believe, but company I've been following for a long time. I love these acquisitions that they're making at once again 2 to 3 times cash flow at a time when I think multiples are going much higher, and I think oil prices are going much higher. Obviously, the upside torque as well on it. You may notice my top 5 names, excluding Prospera. We look at Surge, Meg, Crew, Obsidian, Tamarack. They all have really good cash flow, free cash flow percentages and cash flow percentages. They have really good reserves. They have really good undeveloped land, and they have really good taxable coverage. This is absolutely necessary these days to differentiate yourself versus your peers. Other companies that are paying tax, that don't have reserves, that don't have cash flow, that are not operating properly, etc. So definitely a thesis that I have around this, that if I'm going to be allocating more money to juniors, my top 5 must have these characteristics. And I found 5 that kind of do that. I see no need to diversify that into more names at this point. So that's where you'll see some more portfolio changes coming up, where 2 or 3 of the names will exit, and more concentrated on the names that I want to hold. Obsidian, very similar thesis: production growth, taxable coverage. I don't see the high ARO as a significant concern. They spend about 2 to 3% of their EV on ARO every year. In a $50 oil environment, it's a problem. In a $80, $90, $100 oil environment, doesn't matter. It's basically a nothing burger to me. And I'm more than happy to take on risk, that ARO risk, in order to get in these names that are relatively undervalued. Down about 13% on my position right now. Very, very highly torqued name. And what's the question here? Do you average down or do you hold the line? And I think in names like this, where I already have it as an anchor position, top 5, I just hold the line, leave it be. Averaging down results in an overexposure that happened to me in Whitecap already, and I just don't want that to happen again. So just leaving it be for this point. I did buy the options as I just discussed here. So a way to average down without putting in the same amount of money required in a typical, call it average down in quotation marks. Prospera, it was one of my legacy position. I've got an average cost base under 6 cents on this name, up about 101% on this. And as people know, recently participated in or not just participated, but lead invested and negotiated the private placement with management and the board there. But yeah, I just bought in very, very early, got myself a legacy position so I can track the name going forward. Was very happy with the way things were happening. And so really amplified my position about 250% on a basic share count and about 500% on a fully diluted share count basis. So this is one of the things, I've discussed this earlier, is going to be my new portfolio allocation strategy going forward. I have my top 5 names, and then the other juniors, I will look to allocate much higher portfolio, not just much higher portfolio percentages, but just higher overall exposure to these. Come in, help these companies out, raise capital through our non-broker private placement, and then help them through an engineering standpoint and a business development standpoint going forward. These companies need help. They're just sitting there unknown to the world. They've got really good assets. They've got really good management teams, really solid execution over the last couple of years, and they're now ready to take advantage of the cycle. So this has been my strategy. I think there's going to be 3 names I target. Prospera was the first of them, and likely 2 more that then end up becoming my call it 10 to 15% positions within my portfolios, so such that my top 5 plus my 3 juniors end up in, call it roughly 80+% of my portfolio, and I will run with that then for the cycle as it goes on, along with changes on the side with the other sort of 20-25% positioning. Large original oil in place pools. This is what I target. I want pools with very high original oil in place, with lower recovery factors, where we can hit it with new technologies, new drills, as well as some of the latest optimization kind of techniques. And also, one thing to keep with junior names in mind is as their production goes up, their operating cost per barrel is coming down just by way of like scale, which means your net back is going up, even as oil prices could be flat to slightly increasing. It's a double whammy effect. If you believe in a structurally bullish cycle, that OPEX coming down goes directly into net back. Some of these companies have very, very high operating costs because they're revitalizing acreage that has been left for dead for now 8 to 9 years since 2014. Razor Energy is the other one that has become a larger part of my portfolio here as time has gone on. I've been layering in very, very slowly as the macro becomes clearer. It's another one of those names where the ARO, I think, is not a concern because the debt holder can't take them under, as ARO would get first lien, and the debt holder would be left with very little at the end of the day. With some of these names, I've got this complaint that, hey, how come I can't just buy like, millions of dollars of worth or hundreds of thousands of dollars of position in one day? And I'm like, that's what makes these names interesting to me, that you can build larger positions over a period of time. And the fact that when people want to buy these names, it really increases the torque, how fast they can move. And it also tells you who's in these names. The people that take the time to develop positions at lower cost bases are the ones that are in it for the long run. So you get a natural, although the name is very torquey, you get a natural large shareholder base who are very heavily committed to the story. This has been something I've noticed, not just in this name, but in various other names as well, where junior names hold on really strongly on certain days when the broad oil markets are down 3, 4, 5%. Some of the junior names might even be in the green, and really hold up strongly. I first learned this with Rock Resources, actually. Again, large OOIP pools is what I like. I like the power gen as well. I think it's a very prudent business to have in Alberta, where natural gas price is maybe lower and electricity price is now in a new regime. I call it $80 and higher per megawatt. Per megawatt hour, I believe is a term. Here's my confirmations on when I say layering in, it's literally layering in month by month by month. I don't make any huge purchases all at once. Buy these names kind of as I see large blocks show up that people are facing liquidity problems on margin calls. I'll go in and throw a huge block on the bid and just see, hey, if you want to sell your bigger block, come down to my level and sell them into my bid. I'm not paying your ask, and I've had a really good success with some of these junior names doing that. Pieridae, I've talked about this one before. Very torquey to natural gas. That's literally what it is. Debt to equity ratio of 1 to 1. They have power hedges. I just talked about power being a big cost. They've hedged their power out at about $60 or $50 a megawatt for the next 2 or 3 years. So they're safe for now. And really that's what saved the company, along with the natural gas hedges that they have for Q1 and Q2 of this year. High cost operations require higher commodity pricing. This is a big boys game. Don't get shocked if these companies are moving up and down 40, 60% a month. I mean, these high cost producers that are now coming on the market are heavily torqued. They're also heavily financially leveraged. There's a lot going on in these names, and there's no need to get discouraged if things move against you, and there's no need to get euphoric if things move with you. These names are not long-term holding names. These are rental names that can be traded in and out, I think, quite effectively. And then the equity float construction, the way the equity float is, I think is pretty important. Who holds the majority of the shares? you could have companies that show up as 2, 3, 500 million share floats, yet 40 to 60% of them are held up in long-term accounts. So the actual liquidity is a lot lower. Just things to keep in mind as time kind of goes on in these names could create some really good trading opportunities, not over a day-to-day period, but over a month-to-month period, as you see here. Twice now, it's gone up 40% in a month, 60% in a month, and also come down 60% in a month, twice both ways. So, and that's just over the last 12 months. So, pretty nice natural gas play here. As I've said before, it trades about 1/7 the valuation of Tourmaline. Does it deserve that? Leave that up to you. So I've talked about this as well. I still hold my Prairie Provident, all my shares. There's some legacy hedging issues. A debt to equity ratio of 9-to-1. Please do your own due diligence. Please check your risk tolerance. For those who have followed my price target spreadsheet, you know that for almost 6 months or maybe even longer now, there are certain names that show up as a zero at $70 and $80 oil, even up to $90 oil. So these names are such, that's how they are. Just because I'm talking about them and buying them doesn't mean that your risk tolerance and your portfolio construction is the same. You have to take responsibility for these names if you're entering these names. I have been very transparent with showing zeros on my price target spreadsheet for names that I think may not survive at those sorts of environments. Or I could say it a different way. The equity is worthless in those oil price environments. I've given you a couple of reasons regarding the ARO, why I don't think bankruptcy is a real issue, but that's just my opinion. That's what I've done, my own research. There could be things that I'm missing. So please, when you're entering these sorts of names, I know not everybody's going to do it, but please do your due diligence. Spend a bit of time reading the MD&A, reading the corporate presentation. I don't expect you to do hundreds of hours of work, but something to keep in mind. I think especially for the newer investors who are possibly chasing momentum, I've got a lot of questions about the junior names in the last month or two because I just think that people don't have a strong enough conviction on them, and they don't realize that these companies are effectively worthless at a sub $80 price environment going forward. Yeah, it's the only name that I know of that has a higher than even like a 3-to-1 debt to equity ratio, and they decided to go all the way and be at 9-to-1 where the shares currently stand. I'm down 38% on this position. That's what I signed up for. That's what we kind of signed up for. Would I have liked to have a lower entry point? Sure, but life and the markets don't always work that way to exactly what you want. Avila Energy, I'm down 34% on this name. Entered early before their asset reactivation. However, their development plan overall is still relatively unclear. They did close the Northeast BC transaction, so I think those barrels, those BOEs should be reflected back shortly, which was the entire thesis to begin with. So on some of these names that have, in my mind, 500 to 1,000% up potential, I don't all that much worry about the being down 30% or being up 30% in a short time frame. It gives me a potential to average down, sure, if the original position was kind of small enough where it makes sense to average down, as long as certain parameters are still good. And these are longer term investments. These are actually businesses that I'm investing in, not stocks. I see a lot of my junior names in that same manner. I, in fact, have started seeing some of my small to mid cap names in that manner, that this is a business. When businesses do well year after year after year, they're able to generate their own prosperity by reinvesting that cash and just building the business much bigger than people right now have a vision or can comprehend at this point in time. Keep in mind, all these comments only apply in a $90 plus oil environment. So you need to be convinced on the macro or just have a clear view on the macro before making any sort of investment, strong investment theses or thesis on these junior names. I never run any modeling on these junior names at $70 WTI, $60 WTI. Again, if I thought that was happening, why would I enter the name to begin with, right? Like, just think about things from a different lens. I see this negative skew in the market all the time. It's like what happens if this collapses? What happens if this guy dies? What happens if the well doesn't pan out, right? It's like everything is based on a negative view on things. And hey, I'll say it this way. I'm very happy to take the other side and invest accordingly. Whether it works out for me or not, the market will be the scoreboard in the next few years. It's already been the scoreboard for the last 10 years at this point. I've been in oil and gas markets, but yeah, more than happy to take on that risk or challenge or perceived issues or whatever else. i3 Energy, this is a name that I'm actually right now out of after my January portfolio update. I bought it very, very early at a distressed valuation after their Cenovus acquisition. 18.5 cents was my buy. So I was getting paid about a 20% dividend on my buy price in just about a year and a half. No, just about a year and 1 month. Some of the problems here is that it's a Canadian assets, oil and gas assets, but they primarily trade on other exchanges. However, the high dividend yield did protect the downside for me. The large shareholder exiting is a big problem here. There are some major shareholders exiting their stake. So one definitely to watch for. They may still be dumping shares here. It's one of the only companies that's giving me a mixed oil and gas exposure, or was, and I will be looking to re-enter this in the 30 to 32 cent range, where it's already kind of dropped. I believe, I can't remember what I sold it at, 35 or 36. So I will re-enter this. I just had to sell it at the time. Right now, just a bit around portfolio construction. Still like the name. I still like the dividends. I've got about 11% yield on my dividends already back in the last 13 months. So not only did I get about 100% gain on the stock, I got 11% back in dividends, and pretty convinced in the stock going forward as well. So it's one of the ones I will look to re-enter here in the very near future. Definitely the ACO drop has impacted this, so possibly some deals on the horizon that I can see forthcoming as well. So nice little name. You can look at the way the shares trade, consolidating in this downward pattern. Not that I look at patterns specifically, but it's been in this range for many months now, and I think investors are getting a bit tired, which I will wait for a little bit to see how that plays out, and more than happy to rebuy this one. Very happy with management, very happy with the odd will that does really good, and just the exposure I have to various different plays, and a management that is not afraid to buy scattered assets, which, by the way, currently are trading at still very cheap valuations, to be honest with you. How many more do I have? Okay, so 10th Avenue Petroleum, this is a name that's completely illiquid. It's one that I kind of got stuck in, but I ended up buying this at such a low price when somebody was willing to sell me a pretty huge block, to be honest. At the time, I sold about 60% of my position at about a 20% gain still, and I'm just holding on to the rest. So I'm going to let it ride, see what happens. It could be one of the names that I exit just because there's no liquidity here. The opportunity cost of leaving this here is I think, pretty high. It ended up becoming a position way too big for me on a name this illiquid. Trying to get some understanding of their business plan as well. And, once again, I reiterate, keep an eye for blocks, distressed blocks that show up in these junior names when you have a margin call event, when you have a down days, 5, 6, 7, 8, 10 down days in a row. There are some really nice sized blocks that show up much below the market sometimes. And hey, I just gave you my strategy already. I put in a bid 10, 20% below that. If they want to sell it into my bid, I'm more than happy to take that on and then drip those shares back in when I need to, or hold on to it as a larger position as well. One thing with these junior names that I've learned, you can use your position to create private placements if desired. So some of these companies are sub $10 million, sub $20 million, and it's relatively easy over a period of time to have a 5, 6, 7, 10% stake in these companies between a group of individuals or a group of call it parties. involved parties, which then gives you a little bit of extra leverage in terms of going down that route. If anybody chooses to, as I've mentioned, this is kind of the route that I'm targeting. Not specifically in all the companies I own. There are certain companies that I really feel strongly about, and some of them I actually have no position in currently. So just kind of watching and seeing how things play out. Okay, I got Manganese X. This is my only non-oil and gas investment remaining. I sold my Royal Helium shares last month. This is a name that I entered on very little DD, and a name that I entered on narrative. And sometimes it's a 1% portfolio holding. I treat it like an option. I guess I'll talk about it just because maybe gets brought up at some point. Why is this in your portfolio? So the chairman of the board of this corporation is the brother, is a very highly respected individual in the battery metal space, and is a brother of the individual who invented the lithium-ion battery. His brother runs a lab in Dalhousie that is funded by Tesla to do research on manganese batteries as well. I think it's a 5-year contract. There's a lot more emphasis these days being placed on North American EV battery metal manufacturing. And guess what? North America has zero domestic manganese manufacturing. A Manganese X has a mine in, I think, Quebec, Ontario area. It's got a PEA on it. It's got an NI 43-101 on it. And it's right near the EV manufacturing hubs of Ontario, Quebec, and Detroit. So a complete narrative trade. It's down about 48%, but if you look at the chart on this name, it's too bad I don't have the chart in here. I really wish I could have shown it. The name goes up 300 to 400% about once a year when Elon Musk tweets something on Twitter, or when Tesla has their battery day, it just goes up. So yeah, I guess I'm not all oil, all serious all the time. I give myself 1% of the portfolio to do some crazy things and live a little, as long as it's within reason and it makes sense and it's not taking up most of your portfolio. Enjoy the markets while you're in it. It's a fun ride. It's a great time in here. There's lots of cool things happening, lots of cool companies, lots of ways, people you meet who are very highly convinced on certain things and whatnot. So yeah, I think have fun with it. Don't treat this as always being a serious thing either. It's not always a competition. It's not always try to maximize every dollar out of every trade. There's a component to it that I think makes it all so interesting and fascinating. Okay, so last two, I think, here on the options side, I've got Whitecap options for June 23, Canadian dollar 11 and 12 strikes, paid about 29% to 35% premium, chasing the same stock. Not all that happy that I still have these positions, but I bought these in August and I bought them for at least a 10-month period. So I definitely gave myself more time. So far, nothing has really happened. They're down significantly here, but I still maintain the upside torque, and I'll let them ride. Not a huge position at this point, and just overall macro, I think we'll gain from overall macro environment bullishness. We'll gain from new well results on the Montney acreage, the carbon capture marketing, as I was talking about earlier, and just getting out of this share headwind from all their acquisitions should help as well. So same thesis, hasn't changed. I'm still chasing the same stock. I don't think I'm going to buy Whitecap options ever again once these expire. I've had my fun with them. I've made money. I've lost money. And I guess we'll see how the rest of it pans out here over time. But about a 1% position between these two, the two options. One is slightly kind of almost in the money. One is slightly out of the money. Didn't go too crazy here. Just a little exposure to WCP, which is a name I feel quite strongly confident about, but don't want to buy the equity because of their cash tax situation at the moment. Okay, last two of the junior names. So I've got Canadian Spirit. This is a name I discussed in one of my junior valuation sessions. It's a play strictly on gas reactivation in Northeast BC. There's a sudden catalyst potential from being bought out. For people who are looking for more details, Please check out the Junior Company Deep Dives presentation on it. And then M&A after Blueberry River First Nation. Now that there's clarity around it, there's just more M&A that could potentially occur in this sort of area. Okay, so I'll just get through these two, and then I'll get to some of these questions here. I know I'm a bit behind on the questions. Just bear with me here. So what happened here? Nothing really happened. It's still at 10 cents. It's still illiquid. One shareholder owns 65 to 70% of the float. No action. But what's happening behind the scenes? They said that the 5 wells that they're reactivating will bring on about 2 MMCF per day of gas production. 35% is owned by Canadian Spirit, which means about 0.6 MMCF per day to Canadian Spirit. In my presentation, I made a very strong case that the wells are going to come on at about 5 MMCF per day instead of 2. And I'm going to call this one a little bit of luck, a little bit of geology, a little bit of petroleum engineering expertise. The wells came on at exactly 5 MMCF per day. So about 150% above management's previous expectations. Their share is obviously much higher, again, 2.5 times what they had previously predicted. Hey, if gas prices can cooperate, the company has a business development plan, which once again, I've discussed in my other presentation. Doesn't even cross my mind. I just think about it. I just got it in my position. I don't think about it. I've got the equity in my portfolio. It just sits there until the eventual day when something happens and I get a massive buyout or the company's business development plan accelerates forward in a higher commodity price environment, being Station 2 gas for this particular company. And the last one, Athabasca Minerals. It's my only service side exposure. I like service exposure through niche companies, people that are doing something really unique that can increase pricing power by orders of magnitudes. However, this company is completely illiquid. They don't have the size and scale to be relevant. I shared this in one of the Twitter spaces earlier, that service companies looks like they require 50 to 100 million plus before they get relevant. This company isn't there yet. And a quick comment on the service side stuff. By the way, this is down 41% right now. Not, again, on complete illiquidity, doesn't really mean much. But the question that I bring up with service companies here is, what does book value mean? When every OFS company is trading at cents on the dollar on book value, and then the companies that are buying rigs and buying equipment are buying them at 10, 15, 20 cents on the dollar, does book value really mean anything in these companies quite yet? Hey, you could see that as two ways. You could see that as, book value is not representative. We got to look at EBITDAs and cash flows. Or you could say, hey, at some point in the future, infrastructure will get worth what it's worth. Iron and steel, meaning rigs, equipment, pipelines, other sort of infrastructure will get worth what it's worth at some point in the cycle. I just choose to play it through undeveloped land and reserve values in E&Ps, but I know people are investing in that same thesis on service companies and their value, book value, versus the enterprise value of the company. So with that, I think we'll end it there. Hopefully people got a few thoughts out of that, some new things to think about. Keep in mind, this is just me kind of brainstorming things as I go on. I haven't really had a chance to do a full-on reflection session on 2022, but based on the transactions, I think a pretty good case can be made that there were some learnings, there were some failures, there were some really good trades, some that I'm pretty proud of. And what makes it all, ties it all together is the macro. If the oil and gas macro is constructive, you can make some serious mistakes. You can have some options zero out. You can get stuck in some names. You can have some names that perform quite well, and the odd one that does really, really well, and you end up with portfolio performance to dream of. So I guess just so everybody has the same context, I did share a Twitter thread on this as well. The White Tundra portfolio was up 143% in 2022. On June 8th, it was up 339% year to date. Proceeded to give back about 50% the overall portfolio value from then onwards. So definitely a tale of two halves. But at the end of the day, if the macro is constructive and I'm buying companies at a very cheap valuation, it's really hard to go wrong on an overall basis, which is why I'm in this trade, which is why I spend 40, 60, 80 hours a week tracking these things, more so on the macro side, and which is why I've made it my lifestyle right now, while the opportunity to me kind of has presented itself. So yeah, I think I'll get a few questions here, and then we can kind of wrap it up with a few closing comments. I do want to say this will be, well, this is recorded. It will be on YouTube here shortly later today. And then also I've got the next 2 weeks are off. So I've taken a couple of weeks off. Next week, obviously, is the Super Bowl. So I don't want to be competing with that by any means. And then the week of February 19th, Sunday, I'm just going to take some time off to focus on some pretty major presentations that I'm going to be doing going forward on certain companies, certain multinational companies. Colombia one is coming up, and just some new content to just spice things up, take it away from just company valuation, which I think I've discussed pretty in detail now, and I'm happy with the content that's already out there, where I can just kind of tell people direct traffic, I guess, to those, and then now focus on more petroleum engineering topics and geology topics and sort of overall macro and cool broad-based sort of environments. Okay, so some questions here. What natural gas environment does Pieridae need to thrive in? I'd say at least $3 AECO, but I was betting on a $4 to $5 AECO kind of floor, maybe not floor, but average price going forward. So that's really what I'm betting on, with the odd winter month that goes to $10, $11, $12, which really helps these high cost companies. Yeah, I3, I do believe, yes, they need to sell the North Sea or do something with it. It's needlessly causing confusion. People are still scared of a large part of the free cash flow going into that project there, Serenity project, and also keeps management tied up with not being able to focus on one jurisdiction. So completely agree. I want to say I3 is about 50-50 oil or 50-50 liquids gas. Of the liquids, most of it is NGLs. It's a very high natural gas liquid producing company, but 50% liquids, 50% gas is roughly where it is at this point. Why did I sell Royal Helium? Too much headwind to the recent broker bought deal. I'm not a fan of management's execution at this point. I've held that name for almost 2 years. I do see the upside there still, but at this point, I just found better opportunities to reallocate the capital. I don't want to be following Helium. I don't want to be keeping track of what's going on in the MRI space, in the semiconductor space. It's just taken away from my mantra of quality over quantity. And I did sell it at about a 20% loss, 16 to 20% loss after a 2-year holding period. So, not my best investment by any means. I had kind of tripled or quadrupled down when they made that Imperial Helium acquisition. So actually my real holding period was not that long, but on the legacy position, definitely had plenty of opportunities to make money on this. And it's one of those names that got deflated with the overall COVID slowdown. You see this in many names, non-oil, non-energy, I guess, where they came down kind of with the tech stocks and just took this balloon out of the market. Obviously, the lowering market margin and all that has to do with it. The higher interest payments, the higher Fed funds rates, it all goes in similarity. Pretty big fan of I3 Summinet acreage. Not really all that in tune with their latest well results right now. I will be doing a deeper dive as I look to re-enter this name, as I said, in the 30-ish cent range. And I think the Summinet acreage, Spartan Delta is doing a lot of work delineating this area, and also drilling some really good wells by that naturally fractured formation area. So watching closely, see what happens. Not all that in tune, but I do like the acreage. It's not a huge package. So just keep that in mind. They don't have that much growth potential in this area. It's really just few good wells, and we'll sort of see what happens there. Yeah, I can give you my personal experience is mergers and acquisitions. The reason they're not going through is because companies that are selling already know what they own. They've survived the last 8 years of hell. They're not going to sell for a tire kicking offer. The only companies that sold for a tire kicking offer have already been sold over the last 2 years. Why did they sell? Because private equity wanted out. Private equity had been stuck for almost a decade and they just wanted out. Whereas these other names have better share structures and they're not going to sell for 2 times cash flow. Like, what are you dreaming? After 8 years of living through and surviving the absolute bottom, now that the macro is looking good, now they're going to sell? Doubt it. So that to me, I think is a big, big headwind right now. None of the companies that are trading at 2 to 3 to 4 times cash flow want to pay 6 for an acquisition. Obviously, it would be non-accretive. Not that many other ones aren't in some sense of the word or the other, especially in the US. But yeah, that's what I would focus on. The Montney, I think, is one to really look at. With Blueberry River First Nation out of the way, with LNG Canada getting closer, I think is one to watch. And then just some conventional oil pools as well, I think could be transacted here. Some of these scattered assets could get bought and put into some other companies as time goes on here. Yeah, Surge's hedges, I mean, nothing really at this point. 2023 is pretty clean. Protecting the dividend is about it, is what they're doing. And I would like them to spend some money on exploration. I think they have a large undeveloped Sparky acreage, as well as a lot in Southeast Sask as well, along with their Mount Bastion stuff up in Red Earth Evie. That is a phenomenal acreage at higher oil pricing. Water flood, low decline, with EOR potential, and a potential for even a multilateral drilling in that area in some of the other formations. So as they recapitalize this, put some money into it, I think the production numbers are going to speak for itself, and the cash flow on that is going to speak for itself. And I have 2 to 3 years of tax pool coverage, exactly what I want. Okay, so there's a question here on dividends and what's happened. I will not buy any name with a 10% dividend. I3 I already held for so long that it just naturally became that. But I think companies that already have 8-10% dividends are getting traded at a premium already. Cardinal, for example, trades at about a 40 to 60% premium to Surge for a company that has very little inventory compared to what Surge has. So the dividends are definitely skewing the game. They're more downside protection instruments. But hey, if the company is trading at a premium already and they don't have a catalyst from dividend announcements, why would I want to buy it, right? And I keep it as simple as that. Are they going to cut the dividends? I think the companies are safe. Pinecliff, Birchcliff, and Peyto are all safe right now. I'm not all that concerned. They've got good sort of debt balance sheets, and Peyto as well, I think, has good hedges as well that are protecting them here for the next little bit. Yeah, I'm happy to be on the Super Bowl ads. I can be talking about oil and gas, get some information out there. But I don't think anybody from the NFL has contacted me for a pro bono 15-second advertising slot quite yet. But I do appreciate the support. Excuse me. On Bonterra, I have thoughts, yes. My question is, why should I buy Bonterra over Obsidian? That's always been my question for the last 3 or 4 months when people have asked me this question, and haven't got a good answer yet. I think there's no reason to go down market and lower liquidity if I'm not gaining any sort of neither downside protection nor upside potential. So I just stick with Obsidian, very similar assets, bigger company. I like the more sort of growth focused companies that are growing in heavy oil and medium oil as opposed to the Cardium, which is a hard decline area to begin with. So yeah, those are my kind of preliminary thoughts. But if somebody has a case to make to go down market, I'm all ears. there. So yeah, no, definitely appreciate everybody joining in. I mean, these are always fun. I always have a great time kind of presenting. Time flies by, which means must be having fun. So always great. And I think just more and more interest in the sector as time goes on is going to naturally occur. And if we have, have a little bit of support we can give to some of the newer investors, because this is a very, very complex industry. And if people have some more content to go over and review, I think it's definitely good, and it builds our community as well as sort of time goes on here. So there's a question here on share capital of 88 Energy. There's 18 billion shares. Yeah, I have no idea. This is like Australian stock exchange thing. They like to trade things at 0.005 cents. The London Stock Exchange is doing the same thing. Have never understood what the reasoning is. From a North American standpoint, looks weird, but when you go and look at some of the companies trading on the ASX, it no longer feels all that bizarre. And I don't even think it really matters, to be honest with you, because it's a market cap that really is your main point, and it's your relative valuation along with your downside risk and your upside risk reward expected value sort of modeling that are more important than the actual number of shares and what the share price is. Yeah, so I think I'll kind of end it there with these two final questions. NuVista, yeah, following it. I think it's a nice little play. That being said, there's once again no reason why I should buy NuVista over Crew. They've got worse acreage, they've got less runway, they've got less undeveloped lands. They're in a more, call it, busy area of Grand Prairie where DCET costs are rising faster. There's more labor issues, there's more supply chain problems, there's more infrastructure kind of filling up. I know NuVista has take or pay to even higher barrels per day, but it's still liable to gas processing plants going down because of just like overrunning their operations. So yeah, I guess I'll sort of leave it there. I like the more condensate rich, I call it undeveloped plus developed acreage, rather than things that are well on their development path and don't really have that kind of upside, right? Like, for example, NuVista is at what, 70,000 BOEs per day. Can they 3x their production? Highly doubt it. But a Crew, can it 3x their production from 30, 33, 38,000? Yeah, I think it can. They've got the land base to back it up. So, I would rather get an early stage if I'm, especially if I'm getting a discount, for sure. I would get an earlier stage in some of these companies. The Montney is pretty well delineated. There's not that much risk, like geologic risk to the Montney. We know what's in the lands. It just doesn't show up under reserves because they haven't drilled within the radius or whatever they need to. I'm holding Pieridae strictly as a risk reward bet. It trades at 1/7 the valuation of Tourmaline. If Tourmaline can hold onto these levels at a $2.50 natty gas price, and I'm paying 1/7 for it, I'll take those bets. I like those bets. I think they're good from a risk reward standpoint, especially where gas is right now. I mean, gas is already so low. How much lower can it go, and how much lower can it sustain? I don't think very much lower. Producers will cut production. Producers will cut rigs. Producers will stop new wells from coming online. It happens very fast, much faster than people think on the gas side. On the oil side, it's a lot lower and slower, but gas producers will cut 5, 7, 10% of production in a week if they have to, possibly even more than that if needed. Yeah, I don't have any other plans to do like a preview session. I think the one that I did in a Q3 preview session actually has been my highest watched video. I think almost 15,000 views. So definitely appreciate everybody sharing that and kind of tuning in. Don't really have much to add, to be honest. I'm going to be switching up my presentation schedules, where what I'm going to be moving to is a once a month update. So along with these Sunday sessions, there's going to be maybe a Saturday where I do once a month update on the latest wells, the latest news, the latest M&A activity, talk about some of the latest kind of catalysts, what's happened on my biggest holdings, along with the junior names I'm in, and then also do kind of other names, broad market. So broad market meaning within oil and gas, obviously. So that's kind of what's in store going forward. I think the Q3 presentation gave a good idea to people of the 56 or 58 companies to then go off of. Yeah, for sure. No, it's just like all of these are suggestions that people have given to me. So, well, not all of them, but in some way or another, I see it somewhere that there's lack of information on a certain topic or subject, or somebody shoots me an email that I think is really good. And those are what come into my sessions. So if there's any other suggestions, you want to see something, please feel free to kind of message me or DM me as well. I shared my thoughts on Gran Tierra earlier there, Rez, and then on the Canadian Spirit as well. I've got a whole hour-long presentation there, Nando, that will go really into the detail on that and maybe better. And there's a final question here: if I'm accepting new investors into the fund. So I'll just reiterate, I don't charge for anything. If you get any DM for a mentorship session or something, please don't send any money there. Block the accounts and whatnot. Yeah, I don't run a fund either. So the White Tundra fund, I've shared this in a different session as well, is all my money. It's a completely private fund, so there is no way to invest in this currently, and I don't think there ever will be. So please don't fall for any scams or any fake accounts as well. So I do want to clarify this because I misspoke on my last one of the last sessions on this. So the share structure that I said was wrong with Pantheon versus 88 Energy was a wrong terminology. What I meant to say was the current valuation per share is I think over promised in Pantheon, where the company itself was so inflated in the valuation that it had that the downside risk on it was quite high, and it still, I think, is quite high given where the company is, given the valuation that the company has been given. You cannot just say, oh, we have 10 times more reserves, so we should get valued 10 times more. That's not how exploration plays work. That's maybe how they used to work, I'm not sure. That's not how they're working in today's climate. We've seen companies do this, run this structure, and fail quite miserably in Africa, in the offshore space. Even something like a i3 Energy with their Serenity were quite overhyping things, and it didn't pan out at all. So I think the 18 billion shares or what the share price is not important. What's important is what's the market cap of the company versus what is their current kind of plan. You cannot project things 5, 6, 7 years out and say, oh, this is how much a recoverable oil we have. Especially important because I can show you companies in the Canadian oil space that already have recovered 2P reserves that are trading at 1/3 of their 2P reserves. So when I see an exploration company making a case that we should trade at 2P reserve, I say, you haven't even proved this out yet, and you want more valuation, 3 times more than what the publicly traded companies already have. It doesn't really add up, right? So that's kind of where I am on that. And I'll be honest, I've got quite a lot of pushback on this topic, and this is by no means a negative against that company or this company. What I can say is the market has sort of spoken, right? One company is up 45% since I bought it. The other company is down 20, 30, 40%. So, I mean, there's an obvious overvaluation that the market was giving to one of the names versus the other names. But I do appreciate the passion, because in the oil and gas trade, you need passion, you need forward thinking, you need vision, you need to really be able to project things out multiple years down the road to really, see the opportunity in some of these companies. And we need that. We need more oil exploration. We need more interest. We need more people understanding how oil exploration is, how difficult it's become, and why every field found now of material size is really worth its weight in, not even gold, it's worth its weight in like diamonds at this point. So these are getting harder to find. And I love learning more about these plays. So, if there's any other information that people want to send my way on some of these other smaller names, or even other things they've heard or whatever else, my email and DMs are always open door. So I'll leave it at that. Always appreciate everybody tuning in and sharing the content as well. Really, what makes it all that much more fun, because I could be here just saying stuff to a wall as I was, from kind of 2016 to 2020, talking to a wall. Things have kind of changed a bit here with some of the recent performance. And yeah, thank you everybody once again, and hope everybody has a great rest of the Sunday. Enjoy your kind of week and the Super Bowl and the rest of February. And we'll see you here on one of these later on here at the end of the month, closer to the end of the month. Adios.